to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. You know, anyone that covers markets is going to be surprised about that. You know, you're thinking your BPs of the world or your Glencores, but there's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, you know, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil is going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that two of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that, you know, we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided.
The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment, to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, oh, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So, for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was has Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be part of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world.
Yes, that's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source. and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World World Headquarters. I'm Charlie Pellet. We've got the Dow higher, fading fast, so the S&P, NASDAQ, they're on the minus side. There we go for the Dow, now trading lower. The Dow slumping 11 points as I speak, down by 0.1%, giving up earlier gains. We've got the S&P down 19 right now, down 0.5. NASDAQ down 164, lower by 1.3%. Stocks are trading lower for a second day as risk sentiment worsens after Ukraine's top diplomat said he does not see the progress in Russian-Ukrainian talks. So again, the S&P slumping now by 18 points, down 0.4%. 10-year is down 3/32, 10-year yield 1.99%. Spot gold down 0.6%, 19.85 the ounce, while West Texas Intermediate crude up 2.5%, 108.72 a barrel. Brent, the global benchmark, up 2.2%, 111.77 a barrel. Wall Street, meanwhile, is also looking ahead to next week's Fed meeting. Lauren Goodwin is multi-asset portfolio strategist at New York Life Insurance.
Inflation is absolutely the top concern here for the Fed. We've had an inflation problem for a year. It's well noted. And the growth challenge that's being exacerbated by this crisis is real, but it's highly uncertain.
U.S. airlines will likely recover a surge in fuel costs from customers amid a robust desire for travel, that according to Dave Davis, the president of Sun Country Airlines Holdings. Sun Country shares today, right now they're trading down 2.5%. Other airline stocks also lower. UAL down 0.2%. Delta trading lower by 0.6. Southwest down by 0.8%. Trading in a small Portland, Oregon-based maker of craft spirits, Eastside, has surged after President Biden announced a U.S. ban on imports of Russian alcohol. Eastside, which includes Portland Potato Vodka, surging today. It is up now by 15%. And that's a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio, we are also streaming on YouTube. It is Friday, March 11, 2022. Carol Masser along with Bloomberg Quick Takes Tim Stanovic. Started the week saying it was heavy, and we're going to end with it heavy.
Yeah, we certainly are. Look at that. The NASDAQ 100 seriously underperforming the broader markets today. So tech under pressure again. Carol, the war now getting ready to mark its third full week and start a fourth one.
And that's the weight that we feel, obviously looking at it from so many different angles. We're going to get into that on the Russian invasion war against Ukraine. A couple of stories, including that Ukraine had planned to send a delegation of local startups to South by Southwest for the first time. That plan, of course, disrupted by the war at home. But we do have the entrepreneurs' stories, those that were going to be there.
Yeah, it's a really powerful piece in Bloomberg Business Week. We're also going to have the latest on Wall Street's Russia pullback, unraveling decades of investment. And speaking of the new issue of Bloomberg Business Week, how Wells Fargo left black homeowners behind in a pandemic mortgage refinancing boom. This another heavy piece.
Absolutely. We're also going to talk about what's going on with private aviation. We'll check in with the CEO of Wheels Up Experience. He's also the founder. And then we're talking robots with kids. A favorite guest of mine, Dean Kamen. He's come on a bunch. There's a new documentary about the first
Did you ride your Segway to work today?
I did not. I've been to one of his competitions, though, and to
really
see these
cool
kids
stuff.
And what they're doing, it's really cool. All right, we do have to talk about the markets, and rightfully so. Let's get to the Market Drivers Report. Let's set your Business Week agenda. Kriti Gupta, markets correspondent at Bloomberg, here in our Interactive Brokers studio, along with Katie Greifeld, Bloomberg News cross-asset reporter, and Tim's Quick Take co-anchor. What?
Yeah.
Oh, okay.
Noon Eastern Time.
Did I say
Quick Take
something
stock.
wrong? No, he's just
I'm just celebrating. Yeah.
That is pure joy. All right, I'm also celebrating. It's nice to have Kriti back home. She's been out on the road, but the reporting you've done, I know we've talked about it yesterday. You got back, talking to folks in the energy sector. Very timely to be there at that conference in Houston. But I don't know, with that as your backdrop, with the markets as your backdrop, what's top of mind for you today?
Yeah, I'm still waiting for a clear answer on this, and I haven't gotten one from investors, from my sources, is when do the markets let up? Because I think one of the easiest rules of watching markets is that when you see an extreme move to the upside or the downside, it kind of bounces back a little. And we've seen some pretty extreme moves to the downside. Someone actually told me, I had a trader talk to me today, that a VIX at 30 was the new VIX at 20, which, by the way, was the new VIX at 12
And what does that
pre-pandemic.
mean? Does that mean it's normal?
It means that this is like kind of the new normal. So on a day like today, where you're seeing the VIX hover around 30, we're looking at 29.4 is the handle, or 29 handle. You're not seeing a huge drop. You know, the S&P 500 isn't dying 2% today, which has kind of been the norm in the past couple of weeks. It's only down, 0.4%. And I say only down. I know that's a lot still, but given just the backdrop of a war, of still higher oil prices, I think there's the exhaustion that you're feeling in the markets where you're seeing kind of these not so huge moves. I think the new normal is kind of what you're seeing, especially as we kind of tease out some of these war-specific headlines. And I think there's also, when it comes to the oil market, which is what I think everyone is watching here, as one of the main markets, I think there is kind of this acceptance almost that prices above 100, that's a very real and normal price for the foreseeable future.
Unless you're Mike McGlone.
I was just going to say, thank you for taking
What was
us
his
there.
forecast?
His forecast, and he shared with us a few weeks ago, too, on the program. Was it $50, Carol? Because he has a new note out,
I
too.
actually think a few weeks ago he talked about 30.
Wow.
But I'm trying to remember that. But
We're talking about our Bloomberg senior commodities analyst, Mike McGlone.
He says potential endgame for 2022. He says $50 crude, $2,500 gold, and recession in the U.S.
That's so fascinating because at this conference at CERAWeek, there were calls for like $200, $300 oil. It was wild.
Yeah.
Katie Greifeld, what do you think about that?
Oh my gosh. Well, we're talking about the oil market, and Crudy knows much more about it than I do. But if you look at short-term inflation expectations, break-evens, they are so correlated to moves in the oil market, and they're at all-time highs right now. But
So what's that telling you?
Well, it's telling you that if you look at this move in yields, it's all driven by inflation expectations. You can break it apart, look at real yields, but short-term inflation expectations, they've been at record highs for a while. But if you look longer term at the 10-year inflation expectations, they're at record highs. That happened this week. That is a new dynamic that, okay, we knew that inflation was going to, percolate for a while in the short term.
That's longer term out, thinking that these inflationary pressures stay with us.
Yes, and that is dire. And you pair that with the yield curve, the 2s-10s spread. I mean, this has such a rock-solid reputation for calling past recessions. It got below 20 basis points. I think that was this week.
Where are we right now?
We are at 25 basis points. And
So,
the
flat.
Fed is going to get plenty of questions about that next week.
Right. You do wonder what the Fed says next week, how it tips it. Creedy, that's going to be our focal point at this point. I mean, and obviously the war and the war in Ukraine, no doubt about it. What is it when you think about the Fed and Jay Powell and the impact it could have on the markets? Are you expecting more wild swings as a result of what you might say?
Not from the Fed. Here's where one of the main topics before the war broke out was this kind of divergence you're seeing in policy between the United States, China, and the ECB when it comes to kind of monetary policy. And I think that difference between the ECB and the Fed is going to widen here. You've already had some comments from President Lagarde, I believe. And I don't remember the exact comments because I was not watching this as I was in Houston. But one of the things I believe she said was that we have to kind of really consider being more hawkish to target that war read-through, especially to natural gas prices. But that's not necessarily because the U.S. economy is a little bit more insulated.
And the ECB is just inflation-focused, correct?
Right.
They have a mandate, right?
Yeah, but I mean, you could say that in the U.S. we've met the mandate of maximum employment. So we're kind of at a single mandate right now.
I guess you could, yeah.
But that's where you see the divergence, and that's going to be the question. Does the Fed follow the ECB in this scenario?
But the Fed is hiking and the ECB is on hold.
But the ECB is still removing their stimulus. They were going to keep it till the end of the year. Now they're pulling that up. So it's not as hawkish.
Does wrap up this month, I got to say, for the Fed, which is a sea change.
Yeah,
which is right. Are they selling assets though?
No, but
some
wish they were. Some wish they were.
And Christine Lagarde also, like we're hearing from so many folks who are putting estimates or thoughts out that the Ukraine war does change a lot in terms of our outlook. Guys, got to run. Kriti Gupta and Katie Greifeld here in our Interactive Brokers studio.
Well, let's head to Washington, D.C. now for a check of the latest world and national news. Nancy Lyons standing by in our 99.1 newsroom. Hey, Nance.
Thanks, Tim. The trade pressure is mounting on Russia, with President Biden announcing today the U.S. and other nations are stripping Russia of preferred trading status, or moving that way.
Make it harder for Russia to do business with the United States, and doing it in unison with other nations to make up half of the global economy will be another crushing blow to the Russian economy. It's already suffering very badly from our sanctions.
Biden also announced a ban on Russian-made vodka and caviar. The Russian economy is already in a tailspin. Bloomberg Economics estimates that more than $30 billion has likely already been erased from its annual GDP, and this year's slump is likely to be about 9%. It's unclear if that may have prompted Russian President Vladimir Putin to say he's seen positive shifts in talks between Russia and Ukraine. Ukraine's Foreign Minister Dmytro Kuleba told Bloomberg's Anne-Marie Hordern that's not his takeaway.
Yesterday, I met with Russian Foreign Minister Lavrov in Antalya. This meeting was facilitated by the Turkish Foreign Minister. We spent an hour and a half, and there was zero progress in talks. So it's hard for me to understand what kind of progress President Putin is referring to.
Dmitry Kuleba also told Bloomberg his country is not asking for troops, but desperately needs planes. Without them, he says, more lives and more of Ukraine will be lost. The Texas Supreme Court has paved the way for the nation's most restrictive abortion law to remain in place. Today's ruling again deflated the hopes of those wanting the law either stopped or paused. Abortion clinics say their lawsuit is effectively over. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master, Tim Stanovic. We are live in our Bloomberg Interactive Brokers studio. It is Friday, a lot going on, trying to keep up to date on the headlines involving Russia and Ukraine.
Yeah, more cutting off of the economy of Russia, at least by the United States and multinational companies. We brought you the latest when it came to banks, and we're going to dig into that a little bit later in the program.
Yeah.
Want to talk Budweiser, though, because the Budweiser maker, Anheuser-Busch, is among the latest when it is trying to withdraw from Russia, and in fact the latest global brewer withdrawing from Russia after it asked its a controlling partner that brews Budweiser to suspend sale and production in the country.
Yeah, exactly. The world's biggest brewer, as you said, putting out that statement. It's unclear, though, whether Budweiser beer will remain available in Russia. So they're still trying to figure this all out. But European and U.S. companies we know are rushing to withdraw from the country or suspend operations after that invasion of Ukraine. Earlier this week, Heineken, Carlsberg, Molson Coors Beverage joining the growing ranks of global brands disappearing from Russia. The moves have left Budweiser as one of the last major international beer brands in the market.
Anheuser-Busch, for its part, did say that it's providing financial assistance to 1,800 employees in Ukraine and their families, and that joint venture employees in Russia and Ukraine will continue to be supported and paid. Major brands in Russia made by Anheuser-Busch, they include Bud Alcohol-Free, Spaten, Corona Extra, Velkopopovki, Kozel, and Hoegaarden.
All right, and President Biden said he would ban imports of Russian vodka, caviar, and diamonds, calling also on U.S. lawmakers to join Western allies in revoking the country's preferential trade status following the Ukraine invasion. What?
I just still wonder, Carol, it's something I've brought up time and time again over the last 2 weeks. What is the future of the employees who work for these companies? McDonald's, for example? How long do they continue to get paid if there's no business being done in the country?
Not apples to apples, but I do think about China and how it takes steps to make sure that there is no uprisings in China, right? And in terms of some of the moves that it does, can Russia do the same? Because what's going to happen with those people when there is no economy for them?
Yeah.
What do they do?
And I wonder to what extent joint ventures are bigger in China versus in Russia, and they're more independent operators versus joint ventures.
All right, so these are questions still to be answered. This is Bloomberg.
Connection lost.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. It is a mixed Friday ahead of a weekend. We have got the Dow up 34 points right now, has been swinging between gains and losses. Choppy day for the Dow, but right now up 0.1%. S&P down 15, drop right now of 0.4. NASDAQ down 152, a decline of 1.2%. 10-year yield 2.00%. Spot gold down 0.6%, 19.85 the ounce, while West Texas Intermediate crude now rallying 3.1%. 109.36 a barrel. Bottom line, those stocks lower for a second day in a row as risk sentiment deteriorates after Ukraine's top diplomat said he does not see progress in Russian-Ukrainian talks. After earnings, Oracle up 4.1%, Rivian up down 8.4%, DocuSign after earnings plunging by 22.7%. The Walt Disney Company, its CEO says the company is increasing its support for advocacy groups, also says it will be pausing political donations in Florida pending a review. Those headlines now breaking. We've got Walt Disney shares down by 0.3%. And that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic, and one of our favorite people all time is in studio with us. She's going to tackle some of the most read stories on the Bloomberg. One includes about Wall Street's Russia pullback unraveling decades of investment. This is really coming, Tim, on something we talked about yesterday. JP Morgan Chase joining Goldman Sachs Group in pulling back from Russia in response to the country's invasion of Ukraine and subsequent war in that country.
Well, we're joined now by Shonali Basak, Wall Street reporter for Bloomberg News. She's with us in the Bloomberg Interactive Brokers studio. Shonali, Carol mentioned some of the names there, JP Morgan Chase, Goldman Sachs, which we talked about yesterday, of course. Give us a lay of the land right now, an overview of who's doing business in Russia and to what extent they're actually pulling out now when it comes to the biggest banks.
Yeah, it's very interesting. A little bit of history here is worth getting into. A lot of these banks, Goldman Sachs, Morgan Stanley, JP Morgan, really got into Russia in the wake of the fall of the Soviet Union. And so in 1998, Goldman and JP Morgan, they were huge in terms of not just helping the Russian government, stave off their debt crisis, but also in terms of helping get a very liquid underwriting market for a lot of Russian companies. So fast forward a couple of decades later, they have built fairly robust presences there, but they are much smaller in terms of the whole scope of the operation. So for Goldman Sachs, for example, it's only about 80 employees. For Morgan Stanley, it's a couple dozen, and for JP Morgan, it's a couple of hundred. And for Citigroup, it's much bigger. It's about 3,000. But most of these banks, they started really the retreat back in 2014, the last time we were talking about sanctions. And now...
So they've been pulling back.
They have been pulling back. And so the exposure is somewhat limited. But with that said, as you see by these big funds, there's still billions of dollars on the line for a lot of big asset managers, which are big clients of the banks. So even with these pullbacks, you are seeing banks having to engage in the market-making function of what they do and help their clients unwind a lot of these trades.
Are these banks involved with the oligarchs?
That is the million-dollar question.
More like
right?
billion-dollar, right?
Yeah. Yes, and not just the people who are sanctioned themselves and the people who might potentially be sanctioned moving forward. I mean, that is a very big question because it's not just whether they're wealth clients, but are they involved in any of the assets that they own, and to what extent are any of these people's buyers on the other side of things, right? So I mean, I know that's a very big issue when it comes to the banks unwinding their derivative trades, for example, with VTB on the other side. There are certain banks that have asked regulators for an extension so that they could figure out how to unwind those trades. It is very complicated. Even the entities that are not sanctioned, guys, if you look at the way the CDS is trading, there's a high risk of default. And so there's two kind of buckets of things here. Things that have sanctions already imposed on them, things that might in the future, and things that just come with a lot of reputational risk.
Sounds like an emerging market. No, I'm just thinking about the risk-reward, which is why, right, we see banks and others go into these areas, and we probably thought, because of the wall coming down, how many decades ago, that it was more of a sure thing and a closer move towards a market economy, which we have seen, and yet, here we are.
It's very complicated. And even today, as I sit here with you, I've got to say, I've been on the phone with a lot of people in the restructuring world and in the fund management world saying that, they're wondering who of their peers they're wondering if they themselves want to buy anything on the cheap right now that's not sanctioned. And so it's a very complicated question. They're really worried about the reputational risk, which obviously there's a lot of. So a Wall Street pullback from Russia is, not really the whole story.
I want to hit on the reputational risk element, Sonali. You've been on the phone with sources. You've been parsing through the very carefully worded statements that come from these banks. Are you getting the impression that they're pulling out for good, that this is indefinite, or that there is an opportunity, if tensions ease, to go back in? Because Carol and I have been talking for 2 weeks about the reputational risk of going back to a place where the person in power did something that was so atrocious.
This is on a scale. I asked a bank executive the other day, I was like, can you compare this to any time in your history? And there was just a lot of silence on the phone. This
Really?
is, yes, because, is 2014, are the 90s with Russia any comparison, right?
The 80s in South Africa divestment, which, has come up a little bit, but
this is different. I mean, this scale is just so large. And, the other question, the ripple effect that comes of this is, does this change global geopolitics? Are there other countries they need to rethink?
It will if the sanctions stay in place.
Yeah, and that's the thing. At the end, on one hand, the very simple answer is if you're a sanctioned entity, the government and multiple governments have said no dice. So, it's as simple as that. But on top of that is if they haven't pulled back already from even on the unsanctioned individuals, they don't want to find themselves on the other end of a fine a few years from now.
Right.
And that is just the least of their problems.
Right. And there are costs of going back and forth. BlackRock,
Yes.
just in context, what do we need to, they have they did have 10 trillion, I think, as of the beginning of this year, or roughly the beginning.
It's funny. I'd leave it to you, Carol, to make sure that we're marking to market. Yes, BlackRock with more than $10 trillion under management at the beginning of this year lost $17 billion. That's only 0.2% of the firm's assets. But $17 billion in the pure dollar terms is a lot of money. And if you look at the specific funds themselves, yes, the ones specifically tied to Russia have stopped trading. The ones that are liquid, they've been halted. But there's also liquid funds that are still trading that still have exposure to Russia. It's exposed to tons of different funds around the world, tons of different sovereign debt, and is exposed to Russian sovereign bonds.
You follow this sector, just got 15 seconds. If there's an opportunity of money to be made, would the financial community go back in, do you think? Real quickly.
It's too soon to tell.
Okay. Nicely said. And you covered a lot. Thank you so much. Sonali Basak, as I said, one of our faves, Wall Street reporter at Bloomberg News, here in our interactive broker studio. Check her out at Sonali Basak on Twitter. You're listening to Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You know what's kicking off today?
I do. South by Southwest.
It's the first time in, I think, 3 years?
Yeah, I mean, how do we do the math here, right? It was canceled back in 2020, I remember, because it was such a big deal that they waited until the last minute because of COVID. We didn't know at this point. Carol, this is the 2-year anniversary of the day that Tom Hanks got it. The NBA season was canceled. This was the day I think it became real for a lot of people.
Absolutely. Our last day in studio with a guest was Friday the 13th.
Yeah.
And I know the following week I was starting to work from home. All right, we're going to talk about, though, the entrepreneurs, the startups from Ukraine who were supposed to be at South by Southwest. They're obviously not going to be there, but we're going to tell you about who they are.
Yeah, really powerful story from Sarah McBride. We'll be speaking with her in just a minute. In the meantime, let's get a check on that trading day. Here's Charlie Pellet.
Thank you very much. Now, I remember that day vividly. I was up in the studio with Carol, and I knew at that point that it had become real. I saw that red headline cross on the Bloomberg, and certainly brings back memories hearing you guys talk about it. Speaking of red headlines on the Bloomberg, getting word as I speak, Deutsche Bank in the process of winding down its remaining Russian operations. Developing story. J.P. Morgan Chase and Goldman Sachs this week said they are pulling back from Russia in response to the country's invasion of Ukraine last month. So just how much exposure might other banks have to Russia and sanctions? Myra Rodriguez-Valladares is managing principal at MRV Associates, and she was interviewed this morning on Bloomberg Surveillance.
From a credit perspective, American banks have very, very little risk with Russia. If you look at Goldman Sachs' announcement that it's pulling out, less than 1% of its entire assets are in Russia. JP Morgan, I happened to be working at JP Morgan when it was first getting into Russian markets back in the mid-90s. Tremendously exciting period. But the assets as a percent of all of the over $1 trillion asset base for JP Morgan is very little.
And again, Deutsche Bank in the process of winding down its remaining Russian operations, says there will not be any new business in Russia. Stocks falling for a second day in a row as risk sentiment deteriorates after Ukraine's top diplomat said he did not see the progress in Russian-Ukrainian talks. S&P lower by 11 right now, down 0.3%. Choppy day for the Dow, up 51 right now, holding on to a gain of 0.2%. NASDAQ right now is down by 1%. 10-year yield, 2.00%. We've got spot gold lower by $11 the ounce at $19.85, down 0.6%. Crude continuing to be a big story, up 3.2%, $109.39 a barrel. Briefly after earnings, Oracle right now up 3.3%. We have got Rivian lower by 6.8%. Perhaps the big earnings story, DocuSign, plunging now by 22%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, as we were just talking about South by Southwest, it brings together tech, film, music industries, gets underway today in Austin, Texas. The more than week-long event is in person for the first time in 3 years. This was supposed to be also the first year Ukraine would send an official delegation of startups to the event. That plan, though, Tim, of course, disrupted by the war at home.
Sarah McBride profiles some of those people who were supposed to be there and mostly now is still in Ukraine. She's venture capital reporter for Bloomberg News. She joins us on the phone from San Francisco. Sarah, there's probably no better way to put this than the way that you wrote about it, really at the beginning of your story. Somebody who was supposed to be in Austin, Texas this week, staying in an Airbnb, now finds herself in the middle of the night hearing air raid sirens and waking her 2-year-old up and hiding in a bathroom to try to stay safe.
Yes, that was just the most heart-wrenching story. She and her husband, who's also a co-founder of the company, left Kiev the day before the attack on Ukraine started. They've got their 2-year-old. They had to find an apartment. He's asking what's going on. They tell him it's hide and seek, and they have to hide in the bathroom and look for dinosaurs there and all the stories they tell him. It was just the most surreal feeling. Their whole life has been upended, and I was interviewing her over Zoom, and she could just see the newsroom in the background with everybody just going about their business, and here she was in the middle of a war. It just was the most wrenching reporting experience.
Wow.
You know, Sarah, something that we grapple with, right? Because what we do here at Bloomberg is we report on companies, what they do. We report on the financial markets and world's events, how they impact the markets. And of course, we've done that with the Russian invasion of Ukraine and the subsequent war. So in reporting out your story, right, we cannot forget the humanitarian impact. But you also wanted to shed some light on what these entrepreneurs who've created these companies, what they're doing.
Right. And so, for example, that startup founder who runs a company called EPA makes disposable toothbrushes, and they were getting a lot of traction. They were getting into a bunch of hotels in the U.S. She told me they were talking to Netflix, and she was hoping to use South by Southwest to really build on this momentum. Now, as well as worrying about her family and her employees all over Ukraine, it's also her business. She had a shipment of toothbrushes that are now stuck in Romania. A bunch of their disposable razors are in an office building in Kiev. She has no idea if they're safe or not. And then the other people I spoke to who are trying to juggle dealing with a war and fleeing from their homes and trying to salvage what they can of their businesses and hoping their businesses make it to the other side of this. And they're all at different stages, all experiencing just a crazy range of emotions. And many of them are still in Ukraine. Many of them had to flee to nearby countries like Poland.
So, Sarah, what is going to be going on at South by Southwest in place of where these Ukrainian entrepreneurs were going to be? They were supposed to have a booth there, sponsored by the Ukrainian government. How will they be represented?
Well, the first notion, the first word that many of them got from the ministry, they're all on a Telegram group chat, and they got it. The Ministry of Digital Transformation in Ukraine was supposed to be through various grants funding parts of their trip. And they got a message saying, basically, sorry, we need that money for the war effort. Please return it, and glory to Ukraine. So they, I think at that point, their priorities had already shifted from trying to get to South by Southwest. But there is one person from the ministry who's still going, and there is another representative of the startup community there. They were just kind of frantically figuring out what to do. They were debating whether to have the founders come in by a Zoom link to pitch. The latest I've heard is they're looking for volunteers who can pitch on behalf of these startups at South by Southwest. But the booth is still going to be there, which is impressive.
It is incredibly impressive, and so glad you were able to bring this story to us and remind us of the work that they're doing, and hopefully these individuals get to put out their companies at a future event, and just hope that they stay safe, and so do their families. All right, Sarah, thank you so much. Sarah McBride, she's VC reporter here at Bloomberg News, on the phone in San Francisco.
Well, let's go from San Francisco to Washington, D.C. for a check of the latest world and national news. Nancy Lyons in our 99.1 newsroom. Hey, Nancy.
Okay, Tim. President Biden is calling for an end to normal trade relations with Russia, clearing the way for increased import tariffs. Congress plans to take that up next week. He also called for additional measures to be taken, including a ban on more Russian products,
including seafoods, vodka, and diamonds. And we're going to continue to squeeze Putin. The G7 will seek to deny Russia the ability to borrow from leading multinational institutions, such as the International Monetary Fund and the World Bank.
Biden says these latest actions are in concert with the European Union and the Group of 7 nations. The president is also set to sign a new $1.5 trillion government funding bill that includes $3.5 billion to replenish U.S. stocks of equipment sent to Ukraine, items that some say include additional Javelin and Stinger anti-armor and anti-aircraft weapons. But Ukraine's foreign minister, Dmytro Kuleba, tells Bloomberg what Ukraine really needs is those planes.
If we lose the sky, then many lives will be lost. And part of the responsibility for those lives will be on those who did not provide Ukraine with all necessary weapons, including the planes.
Dmitry Kuleba talking with Bloomberg's Anne-Marie Hordern. Poland has offered to donate some of its MiG-29 planes, but the U.S. says transferring them to Ukraine would escalate the war. Well, there's no let-up in rising gas prices. AAA shows the national average price for regular is up another 2 cents to $4.33 a gallon. In just the past week, the average price per gallon up 50 cents. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much, Nancy Lyon. She's in our D.C. newsroom with World and National News. So in our ongoing coverage of the war in Ukraine, the Russian invasion of Ukraine, and the pushback in terms of sanctions and moves against the Russian oligarchs, we have an update on Roman Abramovich.
Yeah, the London football club Chelsea is trying to work out how exactly it can cover the cost of playing games after the UK sanctioned its Russian owner, Roman Abramovich. Top hotels, private jets, and meticulous catering. Carol, these are just part of the package for a footballer playing in Europe's richest league. The sanctions imposed on Chelsea's Russian owner, though, have left one of the world's most successful clubs with rather more basic things to figure out.
Yeah, the head coach saying last night that as long as we have enough shirts and a bus to drive to the games, we will be there. We will compete hard. He said this just after his team had just beaten English Premier League struggler Norwich City on a day of turmoil off the pitch. So a little bit of football there, European football. But it's, Chelsea was seized by the UK. That was part of the action against Roman Abramovich. What happens next is still being decided. The club in talks with the government about ensuring it can continue to fulfill games, starting with its home game against Newcastle United. That's on Sunday. According to the Times newspaper, on Friday, today, several of the club's corporate accounts, including credit cards, have been frozen, adding further fuel to the question of whether the club can avoid going into administration. I mean, yeah, like how do you function?
Well, that's what's been laid bare, that Chelsea is unviable in its current form without the largesse of its billionaire patron. It's a reflection of a sport whose parlous finances would sink just about any other industry. So in short, it doesn't matter how much something costs if you don't have the money.
Yeah, it's cash flow, right? We talk about this when we're looking at companies, how much money is coming in or how much money they have to play about. What we're finding is the latest accounts show it costs the club about £500 million. That's about $654 million US a season to run. That includes everything from running matchday hospitality to paying those huge salaries of its players. The London club is now limited to a budget of £500,000 to host a game and £20,000 to play away from home. That's a little bit different.
That's real money.
Yeah, this is Bloomberg.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Dow, the S&P, NASDAQ, all lower right now. Dow had been higher in our last update, now down by 12 points, a drop of less than 0.1%. Little change, but in the red, we've got the S&P down 19. That is a drop right now of just about 0.5%. NASDAQ is down 156, lower by 1.2%. 10-year yield, 2.00%. We've got spot gold down $9 the ounce, down 0.5%, 19.87 right now on gold. We do have West Texas Intermediate crude up 3.2%, 109.43 a barrel. Stocks lower for a second day. Risk sentiment deteriorating after Ukraine's top diplomat said he did not see progress in Russian-Ukrainian talks. DocuSign shares plunging after its revenue forecast fueled concerns about its ability to maintain growth that accelerated during the COVID-19 pandemic. After earnings, DocuSign down 22%. Also after earnings, Oracle up 3%, Rivian Automotive down by 6.6%. And that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, today's Bloomberg Big Take, it's also among the most read. It's in the new issue also of Bloomberg Businessweek magazine, which is now online at businessweekandbloomberg.com, also on the Bloomberg terminal and on newsstands. It's a story about how Wells Fargo left Black homeowners behind in a pandemic mortgage refinancing boom, Tim.
Sean Donnan is senior economics writer at Bloomberg News. He's one of the bylines on this exhaustively researched and written story in the current issue of Bloomberg Business Week. Sean joins us from our 99.1 studio in Washington, D.C. Sean, I was really shocked to see these numbers, especially, given that this was over the last 2 years and not something that we think that's, more historical. So I'm just going to go right into it and share the data. Nationwide, only 47% of Black homeowners who completed a refi application with Wells Fargo in 2020 were approved. That compares with 72% of white homeowners. This is according to a Bloomberg News analysis of federal mortgage data. Why and how?
Yeah, look, the question why is something we're still trying to get at. Wells Fargo says that it is simply stricter than other lenders, that it treats all lenders the same, but the data clearly shows a big disparity there. I think, there's the Wells Fargo story. There's also a bigger story here, which is that we've coming to the end of a huge wealth event, really, in America. Something like $5 trillion in mortgages have been refinanced in the last 2 years. When the Fed next week raises interest rates, it will be kind of calling time on that refinancing boom. And a lot of families around America have been able to take advantage of rising home prices, low interest rates, pull out some equity, maybe finance kids' education and so on. And the reality is Black homeowners have had a much harder time, and they had a much harder time than in the rest of the industry when they tried to refinance with Wells Fargo in 2020.
I want to bring in Bloomberg Businessweek editor Jill Weber with us here in our Interactive Broker studio. I feel like I see Wells Fargo, Jill, and I all of a sudden jump back because it does feel like it's been many years of things where, whether it's the culture or something, the company is just not getting it right.
Yeah, the banks had plenty of issues through the years, and the one that Sean writes about in this story, the thing that really just struck me was the data, because when you see the data, it just becomes really stark, and that the part of it that I think is what makes it an interesting Business Week story has been this ongoing coverage we have about how much wealth is locked up in real estate. And when you have access to that, you can really have intergenerational transfers of wealth and rise with it. And if you're locked out of it, you're just always on the sidelines. And Sean, I was wondering, what, being so intimate with this data, and sort of the element of wealth that accompanies homeownership, and what's the cost of the reporting about Wells Fargo in your reporting?
I think a lot of time when we talk about wealth in America and the racial wealth gap, we talk about the gap in home ownership between white and Black families. Black families have a much lower home ownership rate than white families. What was really striking to me here is that we are talking about Black families that have overcome that gap. We are talking about Black middle-class homeowners in the suburbs. The characters we were talking to were in the suburbs of Atlanta. These are not poor inner city black families. These are relatively affluent black middle class families who still have trouble literally leveraging the wealth that they have and taking advantage of this historic event in terms of the low interest rates we've seen in the last couple of years. What's also striking to me, and what I couldn't get out of my head when I was looking at this data, is that a lot of what we were looking at in terms of the practices by banks and Wells Fargo took place in 2020, and at a time when we were having the supposed racial reckoning over the gaps in the American economy. And here it is. It's right there. It's stark. It's just hard to get your head past that. And you look at this and you think back over the last couple of years, and it's hard to come to any other conclusion other than, racial wealth inequality in America has widened in the last couple of years, and housing is a big part of that story, and refinancing is a big part of the housing story.
Sean, who's Christy Furcho, and what is she doing at Wells Fargo, and why is she unique in her position?
Yeah, so she's really interesting. She was brought in the middle of 2020, in the summer of 2020, as the head of the mortgage business there, and she's the first black woman to head up that mortgage business. She's also the head of the Mortgage Bankers Association in America right now, and she is sitting on some panels that are looking at credit in America and how credit scores are divvied out. And she's interesting. I mean, she's someone who is quite frank about the problems that Wells Fargo's had in the past and that the broader industry has in terms of servicing black homeowners. And she makes a point that part of this is cultural and part of this is a legacy. And she, when we talked to her, cited her own mother, who had a 30-year mortgage and never refinanced it once. And this makes Christie's own head spin because she's a banker and she's all about helping people refinance.
Hey, Sean, to be fair, Wells versus other big banks, what did we find out?
Yeah, so Wells has by far the lowest approval rate, or had by far the lowest approval rate in 2020 among big banks. You look at banks like Bank of America. They were in the 60s in terms of an approval rate. JP Morgan had a higher approval rate than that. And Rocket Mortgage, which was the biggest refinance player in 2020, had a rate up around 80% plus. So I think, the gap in terms of Wells Fargo is really, it was the only major bank that approved less mortgages than it rejected. And that's for people who completed applications.
All right, there's a lot in this story, and I highly recommend that folks check it out online on the Bloomberg, or also pick up the newsstand because, again, another revealing story about the inequities when it comes to home ownership. And as Joel mentioned, that has a lot to do with wealth creation when it comes to generational wealth. Our thanks to Sean Donnan, Senior Economics Writer at Bloomberg News, and to Joel Weber, Editor of Business Week.
March is Women's History Month, and every day this month we are celebrating significant moments in women's history. Now with your installment for Friday, March 11, here's Bloomberg's Renita Young.
On this day in women's history in 2006, Michelle Bachelet is sworn in as Chile's first female president. She's a lifelong socialist, former political exile, and ex-prisoner of the military dictatorship. Her rise highlighted a cultural shift in a mostly Roman Catholic country that was long regarded as among the most conservative in Latin America. It was also a nation where at the time divorce was only recently legalized and abortion was still illegal at the time. Women were also often earning as much as 40% less than men with similar jobs. By contrast, Bachelet was an agnostic and a single mother of 3. She was also the first popularly elected South American female president whose political career was established independently of a husband. She served 2 separate terms as president of Chile. That's today in women's history. I'm Renita Young, Bloomberg Radio.
A big thank you to Bloomberg's Renita Young for that update. You're listening to Bloomberg Radio. This is Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close, just 60 minutes left in your trading session, your trading week. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by our colleagues Carol Massa, Tim Stenovic, as we once again go cross-platform, TV, radio, YouTube, to look at volumes down, but stocks down too, Carol.
Yeah, absolutely. We are pretty much hovering near our lows when it comes to the U.S. trade. I've been focusing on China really throughout the week. We've seen so much pressure, and we see that on those Chinese companies that trade here in the United States. The Golden Dragon China Index was down almost another 10% in today's session. It's down about 16, 17% this week. There's a lot of reason why, right? But we
like that index.
Well, I do, because I think we can't take our eye off of China. We obviously have to watch Ukraine, right? But I mean, there is a lot going on in terms of delisting here in the U.S. of Chinese companies, the housing crisis, what will be the Chinese central bank in terms of what they do, the pressures on that
Keeping
economy.
us global. Keeping us global.
We are keeping us global. There's a lot of reasons why, guys.
Well, speaking of stocks under pressure, the New York FANG Index, which actually includes a couple of those Chinese names, but also tech and consumer discretionary companies, including ADRs of those Chinese names, continuing to fall under pressure. Over the last year, down 14.5%, but today down about 3%, with 9 of the 10 names lower.
We're now down on the week for the NASDAQ, all told. We're looking at the NASDAQ currently off by 2.7% over the course of 5 days. It's off by 1.37% on the day, 180 points lower. We're off by about 25 points in the S&P. That's 0.6% lower. Again, off by more than 2% on the week. And you're seeing the Dow, relative outperformer, but still off by 0.1%, and down by 1.5% for the week. And the Russell 2000 as well, underwater on this day by 21 points. That's more than 1%, Taylor.
And you're actually seeing a lot of red on the screen as well. When we take a look for our radio audience at the sector level just below the S&P 500, it is red all across the screen.
Not even energy.
Exactly. Isn't that interesting? Energy, you're still off about 0.25%. Materials and utilities are also some of the least red, though they're still in the red. The worst performer, Romain, and this may not be a surprise, it's technology and it's some of those discretionary stocks.
Yeah.
Those are off 1% when we come off the heels of some of that consumer sentiment number and those rising inflationary numbers that we've been talking a lot about this week.
Yeah, definitely keep an eye on that. And I want to go back to what you just said, Caroline, about the Dow here. I mean, one of the few reasons why you're not seeing a little bit more of a downturn is because of Caterpillar. Shares higher on the day, up 2%. They're on the week, though, they're up about 11%. A lot of people now trying to make bets on who sort of benefits from all the disruptions going on right now in the commodities space. Caterpillar appeals to be one of those names that investors are gravitating to. On this particular day, some folks are gravitating away from JP Morgan. Interesting disclosure earlier today about the potential counterparty risk that JP Morgan has to that big ruction that we saw in the nickel market and that one big Chinese trader, Shuang Da, and his firm. It's hard to kind of quantify it specifically, but according to Bloomberg sources, it's saying that it could be about $1 billion on margin there. We should point out that that nickel trade still shut down on the LME. We'll see what happens when it reopens and whether there are some concessions given there by the LME. We should point out that Gong Da has basically said he's kind of going to potentially double down on some of his shorts, so he's not really willing to pull it back. Just real quickly, keep an eye on McDonald's shares rebounding after the big sell-off over the last few days. And then you were just, of course, talking about this, Carol, with regards to some of those Chinese tech companies. DD Global down 49% right now. And this is big because basically, you remember, they were going to leave the U.S. market and relist in Hong Kong. The Hong Kong relisting now being put on ice because of more regulatory concerns over there in China. $1.77 on DD Global. We should point out, this was an IPO that at the time was at least thought to be going to be one of the crown jewels, probably second only to Alibaba, and it is not done.
Been such an ugly execution. Meanwhile, let's look at what has been a week where we fall in stocks, but we also have, of course, fallen in bonds. And this actually shows the yields pushing higher, the biggest gain in 30 months on your 10-year yield. This has been an extraordinary move, and actually one that there was that really interesting note, of course, coming from the likes of David Wu, saying, like, this could be a value at risk, a sort of VAR shock when you see bonds and stocks move in tandem as we have. But just the seismic moves to the downside, yields getting completely drawn lower as we piled into a haven, and then the week later, we're now worried about the Federal Reserve, what they do, and yields push higher. Carol?
Yeah, exactly, which is interesting.
I did it for Taylor. It's her QE and a QE celebration day, Carol.
Happy end of QE celebration. I'm just going to put that out for everybody. Not so happy, though.
We had cake today over it.
What?
We had cake to
I'm not surprised. I mean,
You
that was
had
all
actually
Taylor, I'm sure.
QE, happy QE.
Taylor, how much have you been looking forward
just
to this?
celebrate QE.
Did Taylor blow out the candles on
Well, I'm
the
kind of
QE
bummed.
cake?
I don't really know what to do on Monday. I won't have anything to say.
Oh,
Yes, you will.
I'm sure you'll find
yes,
something.
you will. And part of it is, folks, you know how we talked about earlier in the week how heavy it was, and I feel like we're ending at least the trading week feeling pretty heavy. Our Anne-Marie Hordern caught up with the Minister of Foreign Affairs for Ukraine, Dmytro Kuleba, because there was some optimism from President Putin about maybe there were some talks going on between the two countries. He really put an end to that. Listen to what he had to say.
There was zero progress in talks, so it's hard for me to understand what kind of progress President Putin is referring to. The Russian army is still in Ukraine. They continue destroying our cities, killing our children, civilians, and it speaks for one fact only, that even if we continue talking with Russia, that does not have an impact on the behavior of the Russian army on the ground.
And that's Dmytro Kuleba, the Minister of Foreign Affairs for Ukraine. What's interesting is, the longer this goes on, obviously the humanitarian costs, we talk about it all the time, right? But everyone is starting to say that, if we hit kind of the month number, then we start to need to rethink a lot of estimates out there and what the business outlook is for the second half of the year. And Tim, I do wonder how the Fed's going to think about this next week.
Yeah, look, and those are the questions that I wonder about. You speak about the humanitarian crisis. More than 2 million people from Ukraine have fled into neighboring countries just in the last couple of weeks. That number continues to rise. And we still wonder about where the world community looks on and wonders about how this ends and what Putin's end game is. It's the cover of Bloomberg Business Week this week, an article by Mark Champion, and it looks at what Putin has done when it comes to other conflicts to try to get some idea as to what actually ends up happening here.
Yeah, and a sobering reminder, that interview that Anne-Marie had, that not only that is the war still going on, but an end to this right now just seems so far off, at least from what we can see publicly. And you do sort of wonder what the overall effect is. You're seeing a reset in relations, economic relations with Russia, trade relations with Russia, and you wonder, does this sort of create sort of a new world order? What's the future going to look like in that part of the world?
And you think about Europe having to downgrade, it's in the ECB at least, their growth forecasts, but interestingly having to focus more on the impact to its own society of higher prices and whether or not, as hard a turn as it is to be discussing a humanitarian crisis at the same sentence as what central banks do. But we have to think about it because that impacts, of course, the rest of society and whether indeed the Fed looks at inflation or indeed whether it looks more at economic growth and livelihoods of people.
It's such a difficult balance, right, between what's going on short term and long term. Really, really tough to kind of grasp and figure out what the right strategy and course is going forward. We're going to continue, guys. We've got lots more to say. We're going to count you down to the closing bell, Beyond the Bell, our cross-platform coverage on radio, TV, and YouTube. We will continue in less than an hour's time. We're going to wrap up the trading week and the trade on this Friday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I feel like I kind of match the U.S. Consumer Sentiment Report that came out today, which was a bit disappointing.
Even lower than analysts had expected.
And the report showing the highest ever share of Americans expecting their finances to worsen in the coming year. So it's inflation, the impact that's having on incomes, just add it all up. And again, I'm saying, for me at least, it's felt very heavy this week.
Who was on our program recently after retail numbers came out? It was about a month, it was 3 weeks ago maybe, after retail numbers came out.
Yep.
And we also saw consumer sentiment numbers and said, watch what consumers do, not what they say, because the sentiment doesn't necessarily match spending patterns. That could absolutely shift, Carol, with the rise in energy prices that we've seen.
Yeah, it might have been Vince Ignorella,
Yeah, I think
our
it was
global
Vince.
macro strategist here at Bloomberg. But I think you're right. And we've talked about all throughout the week, prices, you're going to buy something. I've done it. And it's like, what?
You still bought it.
I did, but you think about things and prioritize. Where do you want to spend your money when things are so?
Can I give a preview of our editors' roundtable?
Yeah, do it.
Okay, Matt Bosler had a really good point. He writes about the Fed for Bloomberg News and Bloomberg Business Week and talked about demand destruction when oil prices and gas prices get to a certain level. That's something to keep an eye on.
Yeah, it's in our weekend radio show and podcast. You can find that Saturday morning and also at our podcast feed. It's also a special, in-depth, and lengthy discussion. It's great.
Let's head to Washington, D.C. for a check of the latest world and national news. Nancy Lyons is standing by. Hey there, Nance.
Thanks, Tim. President Biden is banning the import of seafood, spirits, and diamonds from Russia over its invasion of Ukraine. This means no more caviar and vodka from that country. Biden is also calling for Congress to remove favored nation status, which makes it very hard for Russia to do business with the U.S. But Ukraine's Foreign Minister Dmitry Kuleba tells Bloomberg there's more that could be done.
Close all Western ports for Russian vessels and for foreign vessels trying to bring goods to Russia from those ports. Interrupt supply chains, make Russia feel full isolation.
And Dmitry Kuleba tells Bloomberg's Anne-Marie Hordern no progress was gained during talks he had yesterday with Russia's Foreign Minister Sergei Lavrov, even though Vladimir Putin today said there were some positive steps from those discussions. Well, it appears President Biden and congressional Democrats have lost ground to Republicans on several issues weighing on the minds of voters.
The Wall Street Journal poll finds 57% of voters unhappy with President Biden's job performance, despite favorable marks for the president's response to Russia and the State of the Union speech. Republicans are gaining ground on issues including education, the COVID-19 response, and the economy. Voters say the economy is the most important issue, followed by the war in Ukraine. In Washington, I'm Amy Morris, Bloomberg Radio.
The massive South by Southwest Festival is back in person today for the first time since the pandemic began. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much, Nancy Lyons, in our 99.1 newsroom in Washington, D.C. Carol Massler, along with Tim Stanovic. Great story by our Katrina Manson. Talks about the technology world walling off Russia like never before, but that does pose some risks for the United States.
Yeah, the campaign to starve Russia of technology, stripping the nation of everything from iPhones to Airbnb listings to defense electronics, is an unprecedented experiment that risks pushing Vladimir Putin further into China's orbit.
Yeah, and this is why you've got to look at everything. And this is why I keep bringing up China when I'm watching it in terms of the equity trade. Using export controls as a tool, the U.S. is leading an effort to deprive Russia of components it needs for high-end industry and advanced weapons, with the hopes of ensuring that President Putin feels the pain of his decision to invade Ukraine. That has forced makers of computers, chips, and sensors to halt shipments to Russia.
At the same time, Carol, many of the biggest U.S. companies have gone even further, effectively establishing a tech boycott of the nation. The idea, encouraged by Ukrainian leaders, is that depriving Russians of access to technology and digital platforms will spur popular protest and undermine Putin's military campaign.
Yeah, so we've never done this. No one has really attempted modern technological isolation on this scale before. It's hard to say how Russia's 140 million people will ultimately respond, but cutting Russians adrift from online services may undermine pro-democracy activists seeking to organize anti-war protests, and perhaps most crucially, it threatens to drive Russia closer to America's rivals, most notably China. We have talked so much in this, I hate to call it conflict because it's a war, it's a Russian invasion of Ukraine, but you know, we've seen the alliance between Russia and China specifically, and China increasingly amping up, you know, its role when it comes to technology innovation and certainly production.
There's no historical parallel here. We don't know what happens.
No.
I mean, you can think of entire societies and countries that are shut off from technology, like North Korea, for example, but what they didn't have was this technology before. So if you're in Russia and you had access to, you know, your payment systems, your cash, McDonald's, you know, the apps and services that you started using a lot and you no longer have access to those, what does it mean?
Right, but to also, what does it mean? And then have a huge kind of safety net, perhaps in China, is a big difference.
and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Stocks are slipping lower. 43 minutes to go ahead of the closing bell. What a week. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks are now in the red after a positive start, with the Dow currently down 76 points. S&P's dropped 31. NASDAQ is lower by 200. The U.S. 10-year-old at 2%. Gold is down 9. Oil is trading higher, and Bitcoin is lower by 1.4%. Among the main 11 S&P sectors, all are now in the red, led by declines in telecom, consumer discretionary, and tech. Leaders to the upside in the Dow, McDonald's, Caterpillar, and Dow Inc., while Apple, JP Morgan, and Nike led to the downside. In other news, Deutsche Bank says it's in the process of winding down remaining Russian operations, and JP Morgan is the biggest counterparty for that nickel tycoon's short bets. Also, Chobani is delaying its IPO until the second half of 2022 or early 2023. Wrapping things up, after earnings, Oracle gained as much as 4%, reversing losses of 3.5%. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg Times Squawk SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We do want to get to our weekly crypto segment because this week, President Biden is signing an executive order directing government agencies to focus more on the fast-growing crypto market, from researching a U.S. digital dollar to combating illicit finance. The White House saying on Wednesday, calling on all agencies across the government to coordinate what's thus far been a kind of scattershot approach to the asset class. However, I got to say, Tim, it falls short of providing clear direction when it comes to regulation. Kind of missing.
Speaking of direction, we saw Bitcoin surge on Wednesday after this news came out, which was actually before the executive order came out. That's an entirely different story, though, Carol. Thursday, it sold off a little bit, and today we're actually seeing it lower by just a little bit. Danelle Dixon is CEO and Executive Director of Stellar Development Foundation. Danelle joins us once again from Oakland, California. Danelle, how are you?
I'm wonderful. How are you both?
Oh, doing well. I should note that Stellar Development Foundation, it's a nonprofit. It uses blockchain tech to help unlock the world's potential by making money more fluid and opening up markets and more. Let's start with this executive order. What does the White House executive order mean for the crypto industry?
No, it's just such an opportunity for the crypto industry. I think that what it shows is that there's been so much progress that we've made domestically in the U.S. with the administration as well as with policymakers and regulators to make them pay attention to this particular market and this industry as a whole. And what I'm hopeful that we can get out of this, because it would be amazing for us to have a lot more clarity around the rules of engagement for each of these agencies, so that there's a lot more specificity around what their lanes of operation are. And I think that that's going to just eliminate some of the concern that we see in the ecosystem broadly for blockchain and cryptocurrency about how to operate.
You know, sometimes you have to do something to nudge and get things going. Because I'm wondering about executive order, which can be overturned, right? We know how this works, versus some kind of congressional or regulatory action. So is it a good kind of, administrative step, coming from the U.S. government to kind of get the ball rolling in a more serious way?
Well, the things that I loved about the order, one of them was the fact that it demonstrated and it said very specifically that the United States wants to continue to have leadership on global financial services and specifically on digital assets. That's huge. That's a really important statement to make, because that's one of the things that we've been asking over and over to maintain our leadership here. And so I think that particular statement carries a lot of weight, and it's going to get these agencies to focus on making sure that they're looking at the activity and understanding what part of the activity they need to consider that they need to regulate around. So I do think it's a really nice first step. I think we're still going to see activity at the policymaker level with respect to particularly, I think, stable coins this year. I think that's the low-hanging fruit and a really important part of this puzzle that we need to see sort of act all together. But I think that having an executive order and telling these agencies, hey, this is an important space for us, we can't lose sight of it and we can't fall behind, is really what I see as an important takeaway.
Danelle, what about when it comes to if some of these companies should start to get concerned at all that the scrutiny is going to be on them? It's interesting because on one hand, I think a lot of them are going to welcome some sort of clear guidance, at least from regulators. But at the same time, are any of the business models at risk?
So I don't know whether to think about it from that standpoint. Here's what I'd like to think about it from, and this is what I would tell any of these companies out there, and many of them we work with in the industry holistically. One of the things that we did wrong on the content side of the web years and years ago when privacy sort of came out as being one of those things to think about is we told regulators and policymakers, we don't need your attention, we don't need your help, we've got this. We know how to do this as an industry. And the truth is, as you can see today, we didn't. And we didn't know how to do that necessarily as well as maybe we could have. And so we've learned our lesson there. And so I think now is the opportunity for us to engage with these regulators and these policymakers and these administrative agencies to help them to understand the value and the benefit of what this technology and all these tools that are being built are providing to the individual consumers and to businesses alike, domestically and globally. So I see this as an opportunity for engagement. And sure, there might be scrutiny on certain things, but it's our opportunity to explain what the value is so that you can balance the value with the challenge of understanding these business models. So I ultimately see this as this is our time to sort of demonstrate what we can do for the global financial system. And I think that that's going to be a huge step in favor of blockchain and cryptocurrency generally.
Danelle, we, constantly talk about financial innovation and platforms that hopefully make things more equal in terms of access. We just did a story about Wells Fargo and mortgages for Black Americans and those that, in terms of where they are in the economic strata have, good incomes, success, some would say financially, and yet are being turned down when it comes to, refinancing your mortgage. So I do wonder how realistically will something like crypto be something that moves us in a big way towards more equality financially, and just got about 40 seconds left.
Yeah, I really do think that this is the opportunity for crypto and blockchain to shine. I think we can shine domestically and internationally. The notion of not having to have those minimum balance requirements, the notion of not having to have some of the fees that are attached to it, and the requirement that there's just a competitive advantage for figuring out how to do this better, cheaper, and faster for all consumers. I always say the financial sector is right now focused on on the few, and we need it to be focused on the many. And I think that's what blockchain and crypto can do. So I see not just promise, but real active use cases that are doing that today.
All right, well, cool. So we will obviously reach out to you as things progress, and fingers crossed that this does play out the way that you just said. Danelle Dixon, she is CEO and Executive Director of Stellar Development Foundation. Interesting organization, a nonprofit. They use blockchain to unlock economic potential by making money more fluid, markets more open, and people more empowered. That's their website. I'm reading from it, but that's their mission as well, Tim.
Yeah, Bitcoin, by the way, down 1.3% today.
Moves around, right?
Yeah.
Or so I hear.
It certainly does.
All right, you're listening to Bloomberg Business Week. Yeah, it's Friday, and this is Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yeah, this is Bloomberg Business Week, the Friday edition. Carol Massar, Tim Stanovic, live at Bloomberg headquarters in New York City. Yeah.
It's back.
Chart of the day.
The chart of the day.
What's she doing?
I'm guessing it's about oil.
Guessing it's about oil?
Yeah.
Did you cheat?
I cheated a little bit.
Okay, figure. All right, we're going to talk oil with Kriti Gupta in just a moment. In the meantime, let's talk about the markets. It's another rough day, risk-off trade here. If you're short in the market, Charlie Pellet, you maybe are doing okay, but not if you're going long here.
Indeed, and we have got 28 minutes to go ahead of the bell. Red on the screen. Listen, when we started broadcasting this afternoon, at least Bloomberg Business Week, we had the Dow higher. Right now, looking at the Dow, worst level of the day, tumbling 124 right now, lower by 0.4%. S&P down 39, drop now of 0.9%. NASDAQ, as we bring in the music, down 230 points, drop there of 1.75%. 10-year down 430 seconds, 10-year yield 2.00%. Spot gold down 0.6, 19.84 the ounce. West Texas Intermediate crude up 3.1%, 109.27 a barrel. Brent 112.73. Brent, the global benchmark, up now by 3.1%. Stocks fell as risk sentiment deteriorated after Ukraine's top diplomat said he did not see the progress in Russian-Ukrainian talks. As for the market backdrop, Emily Rowland is strategist at JH Investments.
So until we see a significant deterioration in economic growth, which frankly we're not seeing in the data, we just added 700,000 jobs to the U.S. economy. PMIs are still very elevated. Earnings estimates continue to move higher. We're very, kind of cautiously optimistic here that there is an opportunity to add to positions.
DD Global's ADRs are plunging after the company suspended preparations for its planned Hong Kong listing. The decision came as the Cyberspace Administration of China informed executives of the ride-hailing giant that their proposals to prevent security and data leaks had fallen short of requirements. DD Global shares, they're plunging now by 43.6%. Finally, public health experts at the World Health Organization have begun discussing how and when to call an end to the global COVID-19 crisis. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie breaking down the markets, and I am watching the trade here, Tim. The equity trade, we're seeing some selling into the close. So we are at our lows of the session on those major equity averages. If I look at the major industry group, doing the best, but everything is down across the board. Broad-based selling. Utilities still down, though, about 0.2%. But we're just seeing some selling into the close here ahead of the weekend.
Yeah, tech stocks once again under pressure. Kel, the NASDAQ 100 down about 1.8%. It's being pulled down by a broad sell-off. In terms of the NASDAQ 100, you have only 11 stocks of the 100 in there in the green right now. Apple is the worst performer on a points basis, pulling it down. Tesla, Microsoft, Facebook, Meta platforms, I should say, NVIDIA, Adobe, Google, Netflix, and Starbucks all dragging it lower.
Yeah, and if I look at the week, I mean, energy still holding up about 2% for the week overall. We know the volatility. We've seen some mega swings throughout the week based on the news out of Ukraine and that Russian invasion, but that has certainly roiled the energy market. So energy as a whole up about 2% this week. Bottom of the pack, though, is those consumer staples names. They're down about 5.6%. And then you talk about big tech, information technology is down about 3.5% for the week. So that's where we've seen an intensity in selling. We saw, though, at one point investors come back into the market. We talked about maybe it was a recent, bottom, and so investors saw some opportunities, but we are being very cautious. I think so are strategists, not necessarily ready to call a bottom here when it comes to the equity trade.
Yeah, we certainly heard that from Abigail Doolittle earlier this week as well. Let's get now to Kriti Gupta, who's standing by with her chart of the day. You can sign up for Kriti's chart of the day. You do that at kgupta129 at bloomberg.net. Also, check her out on Twitter and Instagram at Kriti Gupta News. Kriti, your chart of the day after a few days hiatus because you were working so hard in Houston at the huge oil conference. What's your chart of the day today?
Yeah, well, I kind of decided I'm going to wrap up everything I learned in Houston
and kind of put it into one chart. And that's really where I got the inspiration for my chart. It basically shows U.S. oil output. As we talk about the impact of Russian sanctions and what that really means, a lot of the interviews I really had was, where do you go for this alternate source of oil? And a lot of people are looking, obviously, to the American energy sector. The United States is officially a kind of net importer or net exporter, excuse me. So that's going to be a really important part of the conversation moving forward. We know that there's this kind of tug of war between the Biden administration, which is telling kind of producers to ramp up production, and producers are saying, well, we can't, we have supply chain issues. So my chart of the day basically shows that after that big kind of drop in production that you saw in 2020, they are kind of ramping back up, but that takes time. And if you actually look at the trend line, it shows that we're still far, far from getting back to 2019 levels, and even further from replacing that lost Russian supply.
Okay, Kriti, I don't want to speak out of my lane much, but I've been digging into oil production in the United States in recent days as a result of this, and my understanding has become...
He basically has found some new Bloomberg functionality, haven't you?
Yeah, I have. Thanks to Carol and Romaine showing me all the tricks on the terminal. But do we have the equipment here in the United States to actually refine the type of oil that we extract with hydraulic fracturing?
That is a very tough question.
Yeah.
To use hydraulic fracturing. But yes, we do. We do have that ability. And the point you're bringing up here is, are we still able to get our hands on heavy crude, essentially the kind that you refine to turn into things like jet fuel, like asphalt for new roads and things like that, which, by the way, is going to be a big part of the kind of fallout of the Biden infrastructure plan if it gets through. But yes, we do have those capabilities. What we don't have is the amount of light crude, essentially the kind you use for the plastics, et cetera. It's not a function necessarily of refining, it's a function of getting that raw material. But to your point on refining, we're in March, which is really kind of the low point of when refining kind of picks up. From here on out, you're going to start to see a lot more demand from those refiners ahead of kind of driving season in the summer. So this is the low point, and if it's already kind of a stretch right now, you're going to see even more demand in the next couple of months, and that's going to push prices even higher.
I do wonder, right, the longer this war goes on, Kriti, you know, companies have to start making some real decisions about what they want to do longer term, right? And we'll start to see maybe even some really more definitive moves, if you will, whether it comes to capital allocation or, because, right, they're not going to do something if they think it's just temporary, but if they think this is with us for longer, that will be very telling.
And that's what's getting tricky here, because no one is 100% sure if these high oil prices are going to rise or be elevated for the next 12 to 18 months, which is how long it would take for this investment in that equipment, in that refining ability to really be worth it. And that's where you're seeing a lot of the rhetoric from stakeholders saying, we want you to be capitally disciplined. We don't want you to be making these big investments that may not pay off in the long term the way it kind of blew up in the last couple of years.
All right, we're going to run. Hey, Kriti, thank you so much. Have a great week, and a great week for you and all that reporting and insight that we got when you were out there in Houston. Kriti Gupta, Bloomberg Markets correspondent, joining us on the phone.
Check out her chart of the day. Email her, kgupta129@bloomberg.net. Let's get to world and national news. Nancy Lyons standing by in D.C. with an update. Hey, Nance.
Thanks, Tim. Ukraine's Foreign Minister Dmytro Kuleba is calling on more global companies to withdraw from Russia as the attacks on his country intensify. He spoke with Bloomberg's Anne-Marie Hordern.
Stop making blood profits in Russia. Every dollar you make or euro you make in Russia is stained with Ukrainian blood.
Dmytro Kuleba says, despite Russian President Vladimir Putin saying today that positive steps have come out of yesterday's negotiations, Kuleba says he was there and there was no progress. President Biden is ramping up the economic pressure on Russia. As Bloomberg's Irv Chapman reports, he's endorsing bipartisan bills in Congress to revoke the favorable trade status accorded most trade partners.
The president praised congressional leaders for delaying a vote until he brought allied nations to act in unison.
Revoking permanent normal trade relations is going to make it harder for Russia to do business with the United States And doing it in unison with other nations to make up half of the global economy will be another crushing blow to the Russian economy. It's already suffering very badly from our sanctions.
Asked about the possible Russian use of chemical weapons, the president said he would not discuss the intelligence, but Russia would pay a severe price if they used chemical weapons. In Washington, Irv Chapman, Bloomberg Radio.
The U.S. is preparing new penalties against North Korea after determining a pair of purported satellite launches by Kim Jong-un's regime were used to test systems for long-anticipated new intercontinental ballistic missiles. Global news 24 hours a day, on air, and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much, Nancy Lyons, in our D.C. newsroom, our 99.1 newsroom in Washington, D.C. Carol Master, Tim Stenivik. Is Meta among your decliners today?
It is. Yeah, it's down about 50%, Carol, since its highs back in late summer, early fall of 2021. Isn't that remarkable?
It is remarkable.
Yeah.
Like at some point, I don't know, I like some of the technicals, and you do think about, I'm sure, I'm just looking up something like RSI, it's got to be oversold here. It's like hovering, easily towards oversold, but it has been since pretty much the beginning of this year, and it hasn't moved off of it. So, few stories that we should bring to everybody's attention about it. Where do you want to start?
Let's start with regulatory issues in the EU and UK, and then we'll get to what's going on in Russia. Meta Platforms, Google from Alphabet Inc., and European Union and UK antitrust probes those companies into possible collusion over the way that they operate online display advertising services.
So here's what's going on. The European Commission and the UK's Competition and Markets Authority said that they are concerned that a pact between the two tech giants dubbed Jedi Blue could squeeze competitors out of the market for ads on publisher website and apps. Watchdogs around the world have started to home in on the huge power that firms such as Google and Meta's Facebook wield over ad markets, striking at the heart of the tech giants' money-making machines. The EU and UK probes announced today echo allegations in the U.S. We've talked about this a lot. Not necessarily the collaboration or coordination, I think, between the two as much, but just in general.
I mean, they're in the crosshairs of Democrats and Republicans for multiple reasons. In this case, Google has previously been fined more than $9 billion by the EU for other alleged antitrust infractions. Meta is also being probed over suspicions that it misused a trove of data gathered from advertisers to compete against them when it comes to classified ads.
I mean, it's when you become big and the power you have, right? And in this case, in terms of online advertising, this is kind of where you get to the heart of this.
Well, I want to get this other story when it comes to Meta. Russian prosecutors have asked a court to ban Meta platforms, Facebook and Instagram, as, quote, extremists. That's according to Interfax. It's the latest move in a growing crackdown on social networks. Authorities blocked access to Facebook last week under a new media law. And, we're seeing Meta, Facebook under pressure again today.
And increasingly seeing Russia be cut off from the world when it comes to media.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Risk sentiment wanes on war news. The Dow, the S&P, NASDAQ tumbling ahead of the close. 13 minutes to go. Worst level of the day right now. Stocks are falling. Risk sentiment is deteriorating after Ukraine's top diplomat said he does not see progress in Russian-Ukrainian talks. The S&P's down 45 now, down 1.7%. The Dow's down 174, down 0.5. NASDAQ down 246, a drop there of 1.9%. 10-year yield, 1.99%. Spot gold is down 0.5%, 19.86 the ounce, while West Texas Intermediate crude oil higher now by 3%, 109.15. Brent, the global benchmark, up 2.9%, 112.54 a barrel. Briefly, after earnings, Oracle shares are advancing on a down day, up by 2%. Rivian, after earnings, dropping 7.3%. But the big earnings story, DocuSign, plunging after earnings. DocuSign down now by 21.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
The European refugee crises of 2015 and 2022 have at least one thing in common. Vladimir Putin played a big part in causing the former by bombing Syria, and he is solely responsible for the latter with his attack against Ukraine. But the two humanitarian calamities are very different, and therein lies an opportunity for the European Union. In 2015, the EU was divided. To the west, member states led by Germany tried to find an orderly but humane way of treating the asylum seekers while strengthening Europe's refugee system. To the east, member states led by Hungary and Poland closed their doors before the arriving refugees. The situation could not be more different this time. More than 2 million Ukrainians have already arrived in the EU, and yet the reception offered to them so far has been uniformly compassionate. Whatever may divide Europeans, much more unites them, and it could extend to the creation of a military union, a European army, to stare down hand in hand with NATO the likes of Vladimir Putin. The bloc's divisions suddenly look small enough to overcome. With luck, Europeans will recognize this historic moment and seize it. This editorial was written by the Bloomberg Opinion Editorial Board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg Terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. Just about 10 minutes left in today's trading session. We are getting ready to wrap up the trading day and the trading week. And we talked about some selling into the close. Charlie breaking down those numbers. And we are at our lows of the session. Let's talk about the markets. We've got the drive to the close.
Yeah, John Traynor is Executive Vice President and Chief Investment Officer at People's United Advisors. $10 billion in assets under management. John, how are you? It's good to have you with us this afternoon.
Yeah, thanks for having me back.
Yeah, it's good to have you back with us. Just going through some numbers here on the Bloomberg Terminal. The Dow right now headed for its fifth weekly decline in a row. The S&P 500 down for 4 of the last 5 weeks. What are you hearing from customers right now? Are they concerned, or are they kind of just sitting tight?
You know, it's interesting. For the longest time, we were surprised that people were not more concerned about what was going on over in Ukraine. It's filtering through. It's the beginning and the end of every client conversation we have. But, one of the things that we highlight to them, we on our investment call this morning, if you look at your Bloomberg and take a look at performance from the 23rd to last night, the S&P is up, the Dow is up. That most of the damage done to the market was because of, the Fed and inflation and changing interest rate policies. That while volatility's picked up, the market has actually handled this pretty well. So we're reinforcing that with clients.
The longer it goes on, though, How does that start to come undone? I mean, John, one of the conversations we've certainly had with individuals, you heard it from the GE CEO who talked with our David Weston this week. You heard it from Christine Lagarde of the European Central Bank. What's interesting is that the longer this goes on, do we need to start then having a rethink when it comes to the second half of this year?
Well, we absolutely do. I mean, it's probably a foregone conclusion that Europe is going to roll right over into another recession. We were trying to figure out how much we haircut our GDP forecast for the U.S., and that's going to roll right into earnings. So, we were looking for high single-digit earnings at the beginning of the year. We're lower than that now. So, absolutely, it's going to ripple through the U.S. And primarily hit earnings. Absolutely.
How does it ripple through the U.S.? What does that look like? Is it because of energy costs?
Well, again, think about the consumer. I've taken a look at some numbers, and for every penny that the gas price increases, economists will tell you that increase is like a tax increase of $1 billion. So
that's a year. That's per year
over the course of a year.
Okay.
Yeah. So we've already had well over a $100 billion tax increase. That's going to slow the economy. And then when you take a look at the consumer, we've been raving about how the consumer balance sheets are in great shape, but boy, when you see oil prices move up, gasoline prices move up, that's going to have an increase it's going to increase pain in the consumer balance sheet. It's going to impact psychology. So, the consumer has been driving this recovery through goods purchases, and we were hoping for increased services expenditures. We think it'll be the consumer that is going to slow things down. So we haven't figured out how much we haircut U.S. GDP, but we're going to be hopefully we'll still be above 3% for this year.
Recession, it's one thing, even if it's a mild one, if it's touch and go. When people see that, it makes everybody a little bit nervous.
Yep. And I've been doing this now for a little over 40 years, and my best indicator for a recession has been the yield curve, that 10-2 yield curve, and we're in red territory right now. Absolutely. That's been my best indicator. 12 to 18 months later, you've got a recession. So as the Fed starts raising rates, they'll raise them on the short end. I can't imagine that the 10-year is going to be moving up that dramatically. So I can tell you the headlines, fairly soon, late spring, are probably going to be, gee, what happens if the yield curve inverts here? I know Chairman Powell has talked about it, and he's not putting a lot of faith in it, but I think market participants will put a lot of faith in that as a pretty good indicator. So, the fear of a recession will be growing as we move through the year. Absolutely.
It's interesting. Since you kicked off the conversation and talked about what the markets have done since Russia launched that invasion of Ukraine. That was on February 24th. So I looked at the markets as of the 223 close, and the Dow is just off about 0.5%. The S&P is off about 0.4%. NASDAQ is down about 1.4%, and the Russell's actually up almost 1.9%. The Russell had been pretty beaten up. But your point is, and we talk about this, we could get to the end of the year and the markets might be little change, but man, the trip to get there is a rough one, right? Because of the volatility and the huge swings.
Absolutely. And look at what's happened to the European markets. IFA has gotten crushed. The IFA, the emerging markets, and I don't care whether you're in growth or value in Europe, the European markets have really sold off. One of the things you want to look at as an investor is, when you go through something like this, what goes down the least, because that tends to lead when you come out of this. So we are, slightly overweight the U.S. We were debating, do we go to neutral or do we overweight Europe just a few months ago? We're sticking with the U.S. overweight. We think the U.S. is the place to be, just based upon what's happened since the invasion.
Yeah, MSCI Emerging Markets Index is down about 10% since the war started. So if you do the comparison, and this is right, John, when we talk about things, it's got to be everything relative to one another. And investors will be looking at where do I feel the most confident about placing and making those bets, Tim?
John, how long do you see this playing out here? I mean, and just in the last 30 seconds we have with you, is there any chance a recession in the U.S. is on the horizon if we don't see oil prices come down?
Well, there are two things you need to look at. Number one, let's pray that the hostilities end fairly soon. I mean, I'm no foreign policy expert, but I think that will hopefully take place. But the resilience of the Ukrainian people certainly look like they're not going to roll over. That, I don't know. I love to read the foreign policy experts, and they're talking about this becoming Vladimir Putin's Afghanistan. So there'll be two stages. Hopefully, we'll see an end to the hostilities.
Right.
But this will be a headline for quite a while to come. Quite a while.
All right, we've got to run. Hey, John, have a good and safe weekend. We appreciate it. John Trainer, he's Executive Vice President and Chief Investment Officer at People's United Advisors, about $10 billion in assets under management, on the phone from Connecticut. All right, folks, we are just a few minutes away from the closing bell. We're going to head over to our TV colleagues. Our cross-platform coverage, we call it Beyond the Bell, on radio, TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to that closing bell. Here to help take us beyond the bell. It's our global simulcast partners, Carol Master, Tim Stenovic. We welcome in on this Friday afternoon our audiences across Bloomberg Television, radio, and YouTube. Another wild week in this market, Carol. We talk about what happened on Wednesday with that massive rally that we saw in equities, a 3.6% gain on the NASDAQ composite that day alone. But the other 4 days of the week, they've all been down, including today, down 2%.
Makes you wonder, did investors find their bargains and say, I'm done? What's interesting is we just had John Trainer on over at People's United. They've got about $10 billion in assets under management. He said, look at what the market, some of those big indices have done since the invasion of Ukraine. Dow is down about 0.5%. The S&P is down about 0.4%. NASDAQ 100 down 1.5%. Compared to emerging markets, they're down 10%. Europe is down 5%. And the Russell's actually up about 2%. Just to say that where is money going? You understand the impact, but he said you kind of need to compare markets to markets to get an idea of where investors might park some money.
I assume you're talking about on a relative basis, though, right? I mean, we're down, like 5-6% on the NASDAQ since in the last couple of weeks.
Right, but he's saying since the invasion. So to get an idea of the full impact, right? We've had a lot of volatility in that time, but to take a look at the full numbers.
So if we do go back and look over a longer period of time, the Dow this week headed for its 5th decline in a row. The S&P 500 down 4 of the last 5. Yes, the NASDAQ 100 down 3 of the last 5. So we are continuing to see weekly losses here.
All right. We should point out that invasion, of course, officially started on the 24th of February. On this day here, as we sit here on March 11th, 2022, a down day and a down week. The Dow Jones Industrial Average going to finish the day down by roughly 230 points or so. We're going to call it down about 0.7% here. On a weekly basis, we should point out that the Dow is down roughly about 2% here on the week. The NASDAQ composite, let's look at that. Down 286 points on the day, down 2% here on the week. And I just want to point out real quickly here, with regards to the drawdown that we've been keeping an eye on, whether we're going to finally hit that sort of bear market territory, at least from that all-time high, we are now down 20% from that all-time high. Remember, we closed at that level on Monday. We did it again on Tuesday. We had that little bit of a rebound on Wednesday, but we are back now down at that threshold. As far as the S&P 500, it is now back down in that correction threshold, down 10%, more than 10%, 11% from that all-time high, down 1% here on the day. And the Russell 2000, Carol, down about 1.5% here on this particular Friday.
Yeah, no doubt about the overall downward trend. But, this is a market where with the wild swings, you start to look at pockets of trade and try to understand how markets are trading against one another. S&P 500, though, risk-off trade, 411 names in that average, down today, 90 higher, Taylor.
Yeah, and you certainly see sort of the broad-based sell-off, if you will, Carol. I know that an hour ago, we take a look at the first level within the S&P. We now want to take a look at the second level. Just give us a broader view of really some of the individual movers and what's going on. And frankly, it doesn't look good. Even in the gainers, Carol, there is no green. It's utilities, maybe some of the dividend financials that are providing a relative safe haven, but you're still off about 0.4% as some of the best performers. You go down to the bottom, and this is where maybe perhaps it starts to get a little bit more red. And this is that classic risk-off position that we've seen, right? It's software, it's technology, it's semiconductors, it's media, and it's autos. I mean, those are off anywhere from 2 to 4%. 2.4% on the day alone.
All right, so that made it difficult for me to find gainers, and I'm looking at my names and kind of crossing my fingers, hoping that they're still in the green. All right, let's talk about Oracle. It was up about 4.25% higher earlier in the session, still ending with a gain of about 1.5%. We broke down their earnings yesterday. They did have a quarterly profit miss, but they did give a forecast for double-digit organic growth. SocGen upgrading the stock as well, so that stock was higher. Lazy Days Holdings, they make RVs, and this stock just soared up about 20%. Mind you, about 10% of the outstanding has been shorted, so you saw a lot of maybe short covering as well. But B. Riley proposing a $25 a share cash bid for the company, non-binding. They already have an 8.6% stake. Chipotle was up 3.4% earlier in the session, still holding on to about a 0.5% gain here. Barron was out with an article speculating who might be the next one to do a buyback because of the high share price. You can see Chipotle trades at about $14.75 a share, so they were speculating that. So we shall see. We'll keep an eye on it. Tim.
All right. Well, what about when it comes to decliners? No difficult feat to come up with several of those. Let's start with Facebook, Meta Platforms, as it's known now, down about 4% on today's trade. Russian prosecutors have asked a court to ban Meta Platforms, Facebook and Instagram, calling them, quote, extremists. That's according to a report from Interfax. Meta's now down 50% from its September highs. DocuSign finishing it down more than 20% today, closing at its lowest level since March 17th, 2020. So it's now given up all of those pandemic gains. The company reported its revenue forecast, raising concerns about its ability to maintain growth. That accelerated, of course, during the pandemic. And then Rivian, the company finishing down 7.5% today. Shares tumbling to an all-time low after the company reported revenue that missed the average analyst estimates, down more than 77% since that post-IPO November high.
And Rivian, of course, a company that might be feeling the impact of supply chain, might
Definitely,
be feeling the impact of maybe even nickel. Just to reflect on this week, a week where nickel was so volatile, it had to stop trading on the LME for the course of most of the trading days, had to be unwound all of those trades that took it to $100,000 per ton. We're looking at instead a week where actually WTI crude ends up on the day 3%, Brent crude up about 3% as well, $112. It's actually lower versus the beginning of the week. The first time we've seen that since the invasion of Ukraine. And we're starting to see, of course, them pulling back a little bit. But remember, we had Brent at 140 almost. So these volatile trading weeks are extraordinary. We're seeing copper had been managing to hold on to its gains. Natural gas pushes higher, up 3% on the back of maybe weather systems, but also some concern regarding, of course, supply chains there. I'm looking at what an FX story is telling us. $1 strength. We're seeing actually oil move up high, even in the face of stronger dollar today, up 0.5%. I'm afraid the moon music around diplomacy between Russia and Ukraine, not as positive as Putin had been trying to make out at the beginning of the trading day, and therefore we move back into the haven. But we're not seeking the haven in Japanese yen. That's all by a percentage point. 117 is where we trade. That, as we see the ECB get a little bit more hawkish than we're anticipating, and the Federal Reserve, all important on Wednesday, as they move to hike. The Bank of Japan left way behind. And lastly, we look at sovereign bonds, a mixed picture here. Canadian yields push higher. Their jobs data was looking strong today. But elsewhere, we're seeing Italy, Spain. Actually, remember that significant sell-off yesterday in response to the ECB? Well, today we give it back a little bit.
And sort of similar stories, Caroline, when you take a look at sort of the bond market and where we are, yields continue to climb higher. We've talked a lot about this on a one-day basis. We're looking at some of the highest two-year yields that we've had now going back since September of 2019. The 10-year yield hasn't really quite recouped some of the losses. Remember, pre-invasion, we were around a 205, a 206, so we're not quite touching 2%, but we are certainly heading in that direction. But really, a lot of these short-term effects, Carol, have been really felt on the front end, especially on the back of that CPI data.
All right, so we have to wonder at this point, right? The focus now is, of course, we're going to have some economic data leading up to the Fed meeting. We've got retail sales, we get PPI, but it is all about the Fed meeting. And so you do wonder, is the bond market kind of where it will be post the Fed meeting? Do we have everything priced in, or is there something, Tim, that the Fed could say that could really worry investors maybe about the outlook here?
Yeah, well, we'll certainly have to wait until Wednesday to see that. In the meantime, I do wonder what types of questions the press is going to be asking Fed Chair Powell about the way that the humanitarian crisis, Russia's invasion of Ukraine, does risk spilling into not just European markets, as we've seen, not just U.S. markets, as we've seen, but spiking inflation for a longer period of time than we anticipated, and what the Fed can actually do in order to bring that down.
Yeah, I mean, obviously those will be the questions. We got that CPI data. We know that's not going to be the peak just based on the moves higher in commodity prices that we've seen over the last 10 days or so since that last CPI data would have covered. I guess the big question, though, becomes what becomes the new baseline going forward. A lot of people were saying we could get back down to 3%, and we're seeing that revised up now to maybe 4 to 5% in the best case scenario. And of course, break-evens continue to push higher.
And Taylor, you've been so smart at showing what the consumer sentiment, the UMISH data out earlier today was showing about how people are feeling about inflation. Unsurprisingly, very negative, but how worried they are about inflation further out on the curve. The average consumer right now sees inflation being here to stay.
Yeah, I think what's interesting is it was Omer Sharif from Inflation Insights. He's writing in and trying to give us some size and scope here that the number of respondents who are now looking at price increases of more than 15%, that's gone, Tim, from 8% to 19%. So you're really getting a broadening out of those that are expecting some of these extreme moves.
I'll go back to what Vince Signorella said about a month ago after we got CPI data, and then the next week we got retail sales data. He said, and sentiment data, I should say. He said, pay attention to what consumers are doing with their wallets, not necessarily what they're saying in terms of the surveys, how they're feeling. So we'll get that next week.
All right, so it's certainly a lot that's going to be on the Fed's plate, and we're all going to be watching closely. I mean, I don't know. I think it's so tricky, right? This engineering a soft landing in this environment with so much going on is going to be tricky, guys. No doubt about it.
Who walks a tightrope?
Yeah. Right? All right, have a good weekend, everybody. Stay safe. All right, that's going to do it for our cross-platform coverage on radio, on TV, and YouTube. It is called Beyond the Bell, and we will see you again, same time, same place on Monday.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so what would you ask Jay Powell?
Oh, gosh. Does the Fed actually have the tools to bring inflation down?
No.
Oh, I'm sorry, you're Jay Powell?
Well, the thing is, they can impact demand. They cannot impact supply.
Right, exactly.
They have the tools to impact demand, right? They can do that by raising rates and making things more expensive and reducing the amount of money or helping to reduce the amount of money that's out there. They cannot create new supply chains. They cannot start pumping oil. They cannot start planting food. So that's why I can say that. I'm not Jay Powell, but I'm just saying.
But, you know, and you know,
study
so
economics.
you might sleep better this weekend as a result.
All I know is I think the world would just like to see everybody sleeping better and more safely and see an end to that war in Ukraine. But we will see what the weekend will bring.
Let's get a check of the latest world and national news. We go to Washington, D.C. for a check with Nancy Lyons. Hey, Nance.
Hey, Tim. The trade pressure is mounting on Russia, with President Biden announcing today the U.S. and other nations are moving to strip Russia of preferred trading status.
It's going to make it harder for Russia to do business with the United States. And doing it in unison with other nations that make up half of the global economy will be another crushing blow to the Russian economy. It's already suffering very badly from our sanctions.
Biden also announced a ban on Russian-made vodka and caviar. The Russian economy is already in a tailspin. Bloomberg Economics estimates more than $30 billion has likely already been erased from its annual GDP, and this year's slump is likely to be about 9%. So it's unclear if that may have prompted Russian President Vladimir Putin to say today that he's seen positive shifts in talks between Russia and Ukraine. Ukraine's Foreign Minister Dmitry Kuleba told Bloomberg's Anne-Marie Hordern that was not his takeaway.
Yesterday, I met with Russian Foreign Minister Lavrov in Antalya. This meeting was facilitated by the Turkish Foreign Minister. We spent an hour and a half, and there was zero progress in talks. So it's hard for me to understand what kind of progress President Putin is referring to.
Dmytro Kuleba also told Bloomberg his country is not asking for troops, but does desperately need planes. Without them, he says, more lives and more of Ukraine will be lost. The Texas Supreme Court has paved the way for the nation's most restrictive abortion law to remain in place. Today's ruling again deflated the hopes of those wanting the law either stopped or paused. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy, thank you so much. Carol Masser, along with Tim Stanovic, we are live in our Interactive Brokers studio. So there is a story that is among the most read on the Bloomberg terminal by our Sri Natarajan and Donald Griffin. Blah, sorry, it's been a long week, guys, so bear with me.
It has, and this is a complicated story, too, so I encourage everybody to check it out on the terminal.
Yeah.
A Morgan Stanley trader is leaving the firm after racking up tens of millions of dollars in losses as a bout of market turmoil makes and breaks trading books across Wall Street.
Hamza Al-Hassani, he traded dividends in New York, in the New York banks, in the New York-based banks equities division. So he was an equities guy. He'll be departing after transactions he oversaw went awry. According to people with knowledge of the matter, the losses tied to him were less than $50 million, according to one of those in the know. He did not respond to a message seeking comment. A representative for Morgan Stanley declined to comment. So what do we know about this trade?
Okay, so trading dividends, it's a niche of Wall Street financial engineering that lets investors bet on the dividend flows from a basket of shares or even single companies. Market uncertainty in recent weeks has hit dividend books across the street, opening up those trading desks to unexpected losses, according to one person.
All right, so the equity derivatives unit sits within its equities business that also deals in common stocks, provides services to hedge funds. At Morgan Stanley, that business normally seen as a market leader, but it did fall behind Goldman in the final tally last year due to losses tied to Bill Wong's Archegos Capital Management. El Hassani had been with Morgan since 2017, according to brokerage industry records. He previously worked at Deutsche Bank and Societe Generale.
Morgan Stanley is separately facing heightened public attention in another area of its operations, its handling of a large stock transaction known as block trades. The bank acknowledged in a regulatory filing late last month that U.S. authorities are investigating various aspects of that business. It has not been accused of any wrongdoing.
So it just sounds like being on the wrong side of the trade, not necessarily anything went wrong, or I guess we need to know more.
I think we need Sri to come back.
We always
and explain more.
All right. Interesting story. And like Tim said, complicated, specific, very inside in terms of Wall Street, in terms of how the trading goes. But look for more to come. You're listening to Bloomberg Business Week on Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks have just posted their worst week since January as the war in Ukraine rages. Stocks extended losses in late-day trading. Risk sentiment is deteriorating after Ukraine's top diplomat said he isn't seeing progress in talks with Russia. S&P 500 index down 55 today, a drop of 1.3%. The Dow down 230 points, lower by 0.7%. Nasdaq was down 286, a decline of 2.2%. 10-year down 230 seconds, 10-year yield 1.99%. Gold down today by 0.6%, $19.85 the ounce, and West Texas Intermediate crude rallied 3.1%. 109.34 a barrel. After earnings, Oracle had an up day, up by 1.5%. Rivian Automotive after earnings down 7.6%. DocuSign after earnings plunged 20.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Want to get right to our next guest because back with us is Kenny Dichter. He's founder, chairman, and CEO of Wheels Up, and he's joining us via Zoom in New York City. We should point out Wheels Up reporting earnings yesterday before the open. Stock was down about 9% on the news, and we saw some pressure again selling. I think it hit a 52-week low. Kenny, good to have you here with us. I want to talk about the quarter, but I've got to ask you. Ukraine, Russia, we're asking all leaders your thoughts on that and if you're seeing an impact on your business financially or usage of maybe folks overseas somehow tapping into your network.
Well, first off, thanks for having me.
Sure.
And, the Russia-Ukraine situation on a very personal note is just a great tragedy, and I hope that it resolves as soon as it can potentially or possibly resolve. So with that, it's, to watch what's going on there, sort of day in and day out here. There's no place in 2022 for what's going on. I would say we don't have a lot of exposure, Wheels Up, to Russia or Ukraine in our business. We recently announced a deal with a public company over in London, Air Partner. They also don't have a lot of exposure or nominal non-material exposure. But I think that, just where we're at here as a world, I got 3 daughters, and I dream of the day when the 3 will ask me, Father, what was war?
Yeah. Hey, Kenny, want to ask what's been going on with the company. In the most recent earnings, you guys announced that revenue increased 64% year over year. Active members grew 31% year over year. Live flight legs increased 63% year over year. The stock, though, has been getting beat up. What are investors missing?
Well, I think we're looking for an investor base. First off, we went public, first company in our space, private aviation, to go public on a major exchange, the New York Stock Exchange, on July 14th. We raised over $650 million, and we were a SPAC. I think that the SPAC and the de-SPACing process has put a lot of pressure on the whole sector. And I would say, look, our business is not our stock. Our business is our business. We leave this quarter with over $750 million of cash. We have the ability to back lever $250 million worth of airplanes on our balance sheet that we delevered when we went public. So I think we're focused now on running our business. Again, our revenue, a record $345 million for the quarter, up 64%. And, when we went public, we put out a number of $912 million in revenue. We did almost $1.2 billion, so 70% year over year ups. But more important, we were above our revenue guidance. So I think that where we're at as the company is we're looking for a great set of long-term investors. Elon found some great investors at Tesla when it was early. It's early days for Wheels Up. And I think that as we build this business, and build our digital marketplace here, demand is not our issue. It's figuring out how to deal with this incredible opportunity. So we got to find our investors, and that's why I'm on Bloomberg telling a story.
All right. Well, and what's interesting too, I mean, Third Point took a position in you guys. I think it was a 1% position back in November. Not quite sure where they are right now, but I'm curious, are they kind of talking with you and putting any kind of pressure to make some changes though? Because, I mean, the stock is down about 61% since November, and I understand the SPAC argument, but that's since November.
Yeah, like I said, I'm not worried about the stock price. I don't check it on a daily basis. And as Jeff Bezos famously said, that my stock is not the company. I think that if we can execute on what we're talking to Wall Street about, we had a very robust, good earnings call and some great discussion with investors and analysts on the buy side, and the sell side. We're talking to everybody here about what we're looking to do here, which is to create the Uber, the Airbnb, the Amazon of the private aviation space. Again, we're well funded. We don't need to raise money in any way, shape, or form. And again, like I said, I think the stock price will take care of itself if we execute.
Hey, Kenny, let's talk fuel costs here. I'm curious how you are able to absorb these or pass them along to customers. We have seen the increase in oil prices. Jet fuel prices have shot up as well. How much have you had to increase prices or change your model at all as a result of this?
What we have in our contract, and we have a great membership, a great community of Wheels Up people that we fly. We had in our contract an ability to put a fuel surcharge on. We gave notification, and on April 9th, that kicks in. It's a different surcharge per size of your airplane that you're flying on a given day, and it's very fair. Our industry's been able to put it in, and the good news is we have a super sophisticated bunch of men and women and companies that use Wheels Up. They all watch Bloomberg, they watch CNBC, Fox Business, and the price of oil is a daily thing that they're checking. So I think that for us, they're absorbing it starting April 9th, and we'll always look at pricing. We have to price it fairly, and our membership appreciates getting from A to B on Wheels Up. So that's never been an issue. There's plenty of price elasticity in our product and in our space.
Where's future growth? I know customers, active users, up 11% year over year. I am curious, though, customer acquisition, it can be expensive. Are you holding on to customers? Are they using the service even more? And unfortunately, just got about 30 seconds.
Well, very simple is our retention rates are very firm. The more people use it, we have for our biggest users, it's over 90%. So we want to hold on to great customers, but we're willing to invest in our future customers. And I think at the end of the day, the model, membership versus ownership, I think we're fishing in the right pond, and we're excited about the opportunities forward, and wheels are up.
90% retention, and those people, do they continue to grow their usage of the services? It gave you 10 more seconds.
The good news is our most recent cohorts, our 2020 cohort, they are flying more than our early cohorts in an old marketing adage that your earliest customers are your best customers.
Got it.
That's not proving out here. So that's good news for us. And
got it.
We're looking forward to the
run.
future.
Kenny Dichter, thank you.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yes, indeed, everybody. Bloomberg Business Week here on Bloomberg Radio. This is what we call Master Hinge.
It's happening. It's that time of year. Hey, don't forget. Do we have to set our clocks forward this week?
I don't think it's yet. I think it's coming up. But
okay.
The sun is this
Sunday. We do.
Oh, we do.
Yeah, surprise, Carol.
All right. Well, the sun is coming through the studio, and I think the sun's also coming through because we're going to get to talk to Dean Kamen again.
Yeah, we're excited about that. The
Love
founder
his energy.
of FIRST for inspiration and recognition of science and technology. Carol, you've gotten to speak with Dean many times. This is my first time. I'm certainly looking forward to it. Before we get to Dean, though, let's get to Charlie Bellet, who's got an update on what's happening after hours and all the market activity today. Hey, Charlie.
Well, hello there. We had stocks extending losses today. Another losing week for the U.S. stock market today. The S&P 500 index down 2.9% on the week. Again, second weekly loss. Stocks extended losses in late-day trading as risk sentiment deteriorated after Ukraine's top diplomat said he did not see progress in talks with Russia. So the Dow, the S&P, NASDAQ, all declining. S&P down 55, down 1.3%. The Dow was down 230 points today, down 0.7. NASDAQ down 286, a drop of 2.2%. 10-year yield 1.99%. Spot gold down 0.5%, 19.87 the ounce. West Texas Intermediate crude up 3%, 109.21 for a barrel of WTI. Well, what about the outlook for economies in Europe and the United States? That question for John Trainer, Chief Investment Officer at People's United Advisors. He was our guest right here on Bloomberg Business Week.
Probably a foregone conclusion that Europe is going to roll right over into another recession. We were trying to figure out how much we haircut our GDP forecast for the U.S., and that's going to roll right into earnings. So we were looking for high single-digit earnings at the beginning of the year. We're lower than that now.
Trading in a small Portland, Oregon-based maker of craft spirits surged 17% today after President Biden announced an American ban on imports of Russian alcohol. Eastside, whose products include Portland Potato Vodka, reported $3.3 million in revenue for the third quarter. Shares of East, EAST, on the ticker up today by 17.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, a new documentary out. It's called More Than Robots. It follows 4 teams of teenagers from around the world as they get ready for the 2020 FIRST Robotics Competition. The documentary will premiere at South by Southwest this coming week, and 1 week from today, it will stream exclusively on Disney+. Check it out.
When we started this with 20-some-odd teams, now we have thousands and thousands all around the world.
FIRST has given me the opportunity to become better and better and to never stop dreaming.
It is way more than a club. It teaches you the skills of life.
It's technology, respect, teamwork. It is more than robots.
And that is the name of the new documentary, More Than Robots, on the FIRST Robotics Competitions. It was the brainchild of entrepreneur and innovator, holder of so many patents, Dean Kamen. We always remind everybody he invented the Segway. He's been on a mission for years to spark STEM interest and achievement among our young, and it is so great to have back with us Dean Kamen, founder of FIRST, and he joins us en route to South by Southwest. Right now, he's in Memphis, Tennessee. Dean, so good to have you here with Tim and myself. This documentary, tell us about this process and why you wanted to put down and show what you have been doing really for years and really sparking interest when it comes to STEM among kids.
Well, first of all, thank you. You have articulated, you have had so much great data about FIRST and what you just did. And you are one of the crowning examples of why FIRST works so well. I've got 3,700 corporate sponsors committed to helping FIRST become a reality in every school in the country. I have 200,000 volunteer technology people now as mentors working with these teams. We have, tens of thousands of teams, and it's almost exclusively a volunteer organization. It's driven mostly by passion, by smart parents, smart teachers, smart industry leaders, smart government leaders that recognize unless you give kids a shot at understanding what really will be their future if they embrace technology and develop that muscle hanging between their ears, this world's going to be a great place. But if anything, I think FIRST is now becoming more accepted, because 30 years ago, I told everybody, you can all try to solve the problem we don't have, claiming that our educational systems are lacking. And instead, why don't you go after the real problem? In a free society where you get the best of what you celebrate, 30 years ago, and even still to this day, all the heroes, particularly to young women, particularly to minority kids, all their role models and heroes come from the NBA, the NFL, Hollywood, Motown. They don't see young adults successfully pushing ahead in careers in science, technology, engineering, mathematics, inventing. And it's not that those things really are not every bit as fun, as accessible as bouncing a ball. It's just we have a culture that made sports superstars crowd out everything else. But if sports works, all I did, it was very simple. You steal a good idea that works. I said, let's turn science, technology, and engineering into a sport. And then we'll attract all the kids that already love sports. They love the competition. They love the excitement. But let's let them develop that muscle hanging between their ears. It'll be the only sport where every kid on every team can turn pro.
Right.
There are millions and millions of jobs out there in the technical fields.
Dean, take us back to your childhood, though, and talk to us about how you were inspired at an early age and how you see that not happening today. I mean, what did you have access to in your childhood that you want to recreate for children today?
Well, luckily, and very luckily, as a kid, my parents didn't mind that I did a lot of tinkering. I took over their basement. I started building things. I bought, voltmeters and oscilloscopes and played with electronics.
Were you taking apart appliances on your parents?
Yeah, I did all of that stuff. And yes, it sort of frustrated them at times. But I got, as a teenager, I started making money doing technology for people. And I realized that most kids don't see the power of that. And I also realized, my mom is a teacher, and I realized just the way schoolwork goes, you're intimidated in a classroom learning equations. And if you don't get them right, you get a red mark. Whereas that same teacher becomes the coach after school. And if you didn't hit that ball or you didn't get that basket, this teacher that's required to be judgmental in the classroom becomes this coach that's so nurturing that helps you after school. And I said, no wonder kids love sports. No wonder they're intimidated by science and physics and math. Come on, let's get those teachers the opportunity to coach a team that's using all the things that we claim are valuable about other sports, that's using teamwork and exciting stuff to give kids the skill sets they need to build a future.
All right, well, sit tight for a second, Dee. We've got to do a little bit of news, but we're going to come back and continue. I've got to say, I've seen one of the first robotics competitions. It was in St. Louis, near the Arches. I remember it all. And the kids were so excited. There was such great energy. And it was like a sport, the competition, but it was just all in. Boys, girls, from people, all kinds of kids from all kinds of background. Dean Kamen, we're going to come back to you, founder of FIRST, talking about the documentary More Than Robots.
Well, let's get to Washington, D.C. for a check of the latest world and national news. Standing by is Nancy Lyons. Hey there, Nance.
Thanks, Tim. President Biden is calling for an end to normal trade relations with Russia, clearing the way for increased import tariffs. Congress plans to take that up next week. He also called today for additional measures to be taken, including a ban on more Russian products,
including seafoods, vodka, and diamonds. And we're going to continue to squeeze Putin. The G7 will seek to deny Russia the ability to borrow from leading multinational institutions, such as the International Monetary Fund and the World Bank.
Biden says these latest actions are in concert with the European Union and the Group of Seven nations. The president is also set to sign a new $1.5 trillion government funding bill that includes $3.5 billion to replenish U.S. stocks of equipment sent to Ukraine, things like additional Javelin and Stinger anti-armor and anti-aircraft weapons. But Ukraine's Foreign Minister Dmytro Kuleba tells Bloomberg what Ukraine really needs is planes.
If we lose the sky, then many lives will be lost. And part of the responsibility for those lives will be on those who did not provide Ukraine with all necessary weapons, including the planes.
Dmytro Kuleba talking with Bloomberg's Anne-Marie Hordern. Poland has offered to donate some of its MiG-29 jets, but the U.S. says transferring them to Ukraine would escalate the war. There's no let-up in rising gas prices. AAA shows the national average price for regular is now up another 2 cents to $4.33 a gallon. In just the past week, the average price per gallon is up 50 cents. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Massar, Tim Stenovic here on Bloomberg Radio. We're talking with Dean Kamen, founder of First, a new documentary out that will be making its premiere at South by Southwest. That will happen next week. And then 1 week from now, it will stream exclusively on Disney+. It's all about tracking 4 teams of teenagers from around the world as they get ready for their 2020 First Robotics competition. We're going to get back to that conversation. Dean, we just have about a minute and a half here. We wanted to talk about your home in Bedford, New Hampshire. And I was going back to an old story, and someone described it as nothing less than a mini Smithsonian or the Northeast version of the Henry Ford Museum in Dearborn. Can you share with us a little bit about your thinking for your home in New Hampshire? It's where you do your work, a lot of work.
Well, it's got a machine shop and an electronics shop and a great library and a hangar for everybody needs a helicopter in their house. But it's just a place that it's more of a place for convening. Actually, Bill Gates was visiting me at one time and said, "Dean, I think your house represents the physical manifestation of what's inside your head, and it's a cross between a museum of science and technology and Willy Wonka's chocolate factory." And I considered all of that a compliment. But the important thing for your listeners is while I'm so excited that First is now in tens of thousands of schools and affecting over 1 million kids, it's sad that all kids everywhere aren't aware of it. And so if Bloomberg and if the Disney Plus streaming of this program can reach millions and millions of kids and parents and teachers, we really we will transform the future of what kids in this country aspire to do, what they become as adults. And I think they named this thing so perfectly, More Than Robots. Please let people know it's not about being geeky and building robots. I've been saying for 30 years, it's not about robots. It's never been about robots. We don't use kids to build robots. We use robots to build kids.
Dean, hang on for a second. We're going to do a little bit more news, and we're going to come back and continue with us. Our guest right now, Dean Kamen, founder of First. He's going to come back to us in just a moment on Bloomberg.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks just posted their worst week since January as the war in Ukraine rages on. Investors, though, still vacillating between panic selling and dip buying. Today, we had the S&P down 55 points, a drop of 1.3%. Stocks did close at the worst level of the day as we head into the weekend. The Dow Jones Industrial Average down 230, down 0.7%. NASDAQ dropped 286 points today, down 2.2%. 10-year yield 1.99%. Spot gold is at $19.86 the ounce, down 0.5%. Crude another move higher today. WTI West Texas Intermediate crude up 3%, 109.16 a barrel. Brent, the global benchmark, up 2.7%, 112.27 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We do want to get back to Dean Kamen, who is with us. Founder of FIRST, as we mentioned, stands for Inspiration and Recognition of Science and Technology, creator of the FIRST robotics competitions. And we've been talking about the documentary More Than Robots, which will premiere at South by Southwest this coming week. And 1 week from today, it will stream exclusively on Disney+. Dean is still with us on the phone from Memphis, Tennessee. And we should point out the movie tracks 4 groups of students who are competing in the 2020 FIRST robotics competition.
Yeah, Dean, it's great to have you back with us. I want to talk a little bit about where we are as a society and trying to really understand how we can get more kids into STEM and what we need to do as a country in order to do that. And I want you to draw parallels between, again, how you were able to get inspired and lead the life that you have, and how you can, in turn, see that happening with kids today. I just have to say, the world has changed so much, and I wonder if we have the educational infrastructure in place today for kids to thrive like they did, in the 1960s.
So I believe we have the educational infrastructure. Everybody I know has a teacher that they think changed their life. We've got the best systems in the world. We spend more per capita on education than anybody in the world. That's the whole point of FIRST. It's not a education crisis, it's a culture crisis. It's not what we don't have enough of, it's what we have too much. In a rich culture, in a rich society, we've been able to turn leisure time into a phenomenon. We've turned sports into something bigger than life itself, and it's crowded out to kids the idea that they can excel at something else, they can become superstars in some other way. And the entire premise of FIRST, look at our name, for inspiration and recognition of science and technology. Kids will always do better at something if they're inspired to work hard at it. That's why the U.S. still leads the world in sports and in entertainment and Hollywood and the NBA. So we just said, let's take that model and create a sport that will be available to all kids, again, particularly women and minorities in the United States that are so subtly but effectively convinced by the time they're even in middle school that science, technology, and engineering is difficult, it's frustrating, it's boring, it's only for the gifted few.
Right.
And ironically, it's where all the big jobs are going to be. So these kids have to get into it early.
You took me exactly where I want to go. Tim and I were part of a Bloomberg Live event. It was all about work shifting and just how things are changing post-pandemic. But every executive, whether it was at that event or every executive who comes on air, I mean, everybody's a technology company. Doesn't matter what industry you are. You need IT workers, tech workers. That's just the world that we are in. And I do wonder, everybody says that there's just not enough out there. Has the message gotten out there? You have been doing this for a while, and I still see a lot of money spent on big, sports programs, whether it's in colleges or even, at lower level. Are you seeing an impacted change since you started doing this?
We are certainly seeing a change, but you're right. There's still overwhelmingly more money and excitement thrown by the media, particularly at making sports bigger than life, and they somehow have still failed to include us as the ultimate sport that humans ought to participate in. But as an example, you say, is it working? When you look at the 4 teams that participate in this great documentary, you'll see that one of them, 2 of them, one's from Mexico, one's from Japan, 2 are from the U.S. They're both in California, and it turns out that each of them has a mentor. One's a teacher, and her husband's the mentor for the competitive team. He works at Raytheon, and he's hired more than 25 of the kids that have come through this essentially an inner city school system that wouldn't have produced any kids that could go work at Raytheon. And when you look at the 3,700 corporate sponsors we have and a couple of hundred universities that are at all our big events scouting just like the football team does, the reason these 3,700 sponsors are there is, as you pointed out, every major company in the country and in the world is desperately looking for more technically competent people. And the best way to create them and to build a better pipeline is to start earlier and have these tech giants and even the tech startups be there, giving these kids encouragement and inspiration and making this the sport of choice for kids, because it is the only sport where every kid can turn pro.
Yeah, I got to say, your board of directors has always blown me away. Ursula Burns, right, formerly of Xerox, now with Teneo. You've got Rockwell, the former chairman and CEO of Rockwell Collins, Rockwell Automation, Two Sigma, David Siegel. These are people that are certainly familiar. Pick any of those big companies in the STEM world, and they are there. Hey, one thing I wanted to ask you, if you will indulge us a little bit, is I know I've talked with you before about North Dumpling Island. That's in Long Island Sound. I've passed it when I'm out in the water. What's interesting is you are, I believe, right, operating independently of the regional electrical grid there, right? Solar, wind, it's a home that you've got there. And I do think about the last couple of weeks, with the Russian invasion of Ukraine, and we've seen the volatility in the energy markets, and you see the EU moving aggressively to wean itself off Russian oil. Everybody talking a lot more about alternative energy, solar, alternative energy power companies, rallying as a result. What's the big think that we need to be having here?
We are at the perfect storm, and this could be the catalyst that makes it all happen. But power semiconductors are now available to make highly efficient grid quality AC out of just about any energy. Wind, batteries can be now efficiently used to both store and then redeliver, whether it's DC or to the grid. But for many reasons, it's good for the environment, it's good for the economy, it's good for our national security, it's good for business. And finally, solar power, wind power, all of them collectively are starting to become realistically capable of taking on more and more of our energy loads, and as well as building more efficient lighting systems like LEDs and come up with better ways to make our computational stuff more efficient. I mean, at this point, believe it or not, more of the power coming through our grid is powering computation and data centers than lighting, and it's getting more so. So I think if you look at it holistically, for all sorts of reasons, we are reaching a tipping point where energy is going to be transformed in how it's made, how it's stored, and how it's transformed. And by the way, doing all of that's going to create enormous, exciting jobs for kids that can embrace technology.
Are you optimistic that this happens within a few years? I mean, I just don't see the political will.
And just quickly, just got about 30 seconds.
You can talk about political will, but when you see the price of fuel go through the roof, when you see the availability of fuel go through the roof, that trumps political will anytime, and it will make it happen. Necessity is the mother of invention, and we got a lot of necessity on energy.
All right, Dean Kamen, thank you so much. Dean Kamen, founder of FIRST, on his way to South by Southwest. Why is he going there? Because that's where More Than Robots, the documentary about kids involved in that FIRST robotics competition, will premiere this coming week, and then 1 week from today, it will stream exclusively on Disney+.
I'm going to be checking that one out.
It's I got to say.
March 18th, Friday.
We had some great video running on YouTube for those who are watching. It's just amazing what these kids do. They build all themselves and then compete. We made it, kiddo.
We made it. Weekend.
We're thinking about everybody in Ukraine. Fingers crossed that this comes to some resolution. We've got lots of conversations about that and more in our weekend show and podcast. Have a safe weekend, everybody.